begin with chapter number 4 now, my friends. Now in chapter number 4, that is international trade, as you are already aware of, there are 5 units. How many units? 5 units. Which are they? First one is theories of international trade. Second one is instruments of trade policy. Third one is trade negotiations. Fourth one, exchange rate and its economic effects. Fifth one will be international capital movement. Where in this particular chapter, students, in all other chapters, the marks in your examination in the past papers have been wavering, going up and down. But in case of international trade, it has always been maintaining at its highest level. That means this is one of the highest weighted chapter, students. So I will not be wrong to say this, that it is one of the most important chapters in your syllabus. Now, I am very sure you have studied this very exciting topic very nicely. So quickly we are going to revise all the 5 units, students, so that you have that in your mind while you are appearing for the examination. Now friends, just coming on to the first unit, we are going to start with the first unit, that is nothing but theories of international trade. What's the name again? It is nothing but theories of international trade. Now when we talk about theories of international trade, my dear friends, it will be divided into 2 parts. How many parts? Come on, 2 parts. Which are the 2 parts? How many parts? 2 parts. Which are the 2 parts? First one is advantages and disadvantages. Come on, which one is the first one? It is nothing but advantages and disadvantages. And what is the second point that we are having, students? These are nothing but the theories itself. So first part, friends, it is nothing but what are the advantages and disadvantages. See, everything that in our country we do, it will always have its 2 sides. It will have some merits as well as some demerits. So we need to take care of both the things, merits as well as demerits. When we are talking about theories, friends, in theories there are 5 types of theories that we are going to cover. First one is mercantilist's view. First one is what, students? First one is nothing but mercantilist's view. Second one is theory of absolute advantage. Third one would be theory of comparative advantage. Comparative advantage. Next one will be HO theory, which is nothing but Haksha and Ohlin theory. Fifth and last one would be new trade theory. These are the theory, students, which you need to know very, very, very nicely. Okay, very vital topic. Let's begin with the first part, that is about advantages and disadvantages. But before going there, just a quick introduction of international trade, and we are going to compare that with internal trade. So let's begin. When we are talking about international trade, internal trade, just what it means. So international trade is nothing but the exchange of goods and services as well as resources between the countries. See, friends, when we are talking about goods and services, this is very easy to understand, right? But when we are talking about resources, what are resources? These are nothing but factors. That means we are not only trading in goods today, as far as trade is concerned, we are also dealing with land, labor, capital, entrepreneur. However, land cannot be moved from one place to another, but we can give our land to the foreign companies for using it, right? We can transfer capital from one country to another. Now laborers can be moving from one place to another. So all this is nothing but international trade. So that is about international trade is nothing but exchange of goods and services as well as resources between countries. There are some sentences which are very important, which you need to by heart, students. If you have this in your answers, it is highly, highly, highly recommended to have these words, have these sentences. If you are able to by heart, then it is great. If not, then you can write it in your own words, no problem. See, as such, you are writing the entire answer in your own words, right? So there are few words, if you add that, that will be vital words which will help you in scoring more marks. So please keep that in mind. It involves what? Transaction between residents of different countries. Now this type of question, students, how many marks this question would be asked for? 2 marks. So whereas domestic trade, now do you know what is the meaning of domestic trade? Yes. So domestic trade or internal trade, it involves what? It involves exchange of goods and services within the domestic territory of the country. Next one, students, international trade involves transaction in multiple currencies. There are multiple currencies which are involved, whereas in domestic trade it will of course be only one currency, that is our domestic currency. Now compared to internal trade, international trade is slightly more difficult, slightly more more complex. Now when I say complex means what? It involves heterogeneity of customers, different currencies, different legal systems. More documentation will be required. There is diverse restrictions in the form of taxes, regulations, duties, tariffs, quota, trade barriers, standards, restraints to movement of specific goods and services, and issues which are related to shipping and transportation as well. So if you see the students, as compared to the domestic or internal trade, international trade will be having slightly more complexities. After that, for international trade, certain rules of trade are followed by the countries which are made by international bodies. So which is the body which governs the entire international trade across the globe, students? So it will be WTO. You need to remember this name. You need to write this name in your examination. So I hope you are very clear in this part, that is the way internal trade versus international trade. Now let's begin with the merits and demerits of international trade. Now when we talk about merits, these are nothing but advantages. What are the advantages of our international trade? Let's have a look at it. So first one, students, it leads to economic efficiency. Now what do you mean by economic efficiency? See, it's very simple, right? So if we go for international trade and let's say our exports are greater than imports, what will happen? Our productivity as well as our production will increase. If our production increases, students, what will happen? The income in the economy will also increase. If the income increases, the employment will also increase. So income, employment, production, all these things are increasing. That means our economy is becoming more and more efficient day by day. So that is economic efficiency. Next one, students, it includes companies that to reap the quantitative as well as the qualitative benefits. So there are going to be quantitative progress as well as qualitative progress as far as international trade is concerned. Apart from that, students, manufacturing capabilities and benefits from economies of large scale operations. So large scale operations means we will be able to get economies of scale. So economies of scale is a big advantage for our economy. Next one, reduction in domestic prices due to increased competition. Reduction in domestic prices is one point, and also the standard of living of our citizens will definitely increase thanks to international trade. It also provides us a new market access and also helps us in creating the jobs. Now when it comes to jobs, students, you need to remember two types of jobs are created. One will be direct employment, the other one is indirect employment. Now what is the difference between direct and indirect employment? See, when the foreign entity comes and invests in India, so whatever employment they are creating within the organization, it will be direct employment. If they are creating an indirect form of employment for others, for their associates, for their subordinates, then that will be called as indirect employment. So that's about the advantages. Now let's focus on the next part, that is nothing but disadvantages. Now when we talk about disadvantages, friends, the main arguments which are against the international trade, which are they? Number one, negative labor market outcomes. Now friends, tell me one thing. When these international traders, international companies come and start their business in India, will they be focusing on a labor intensive technique? No, they will be focusing on capital intensive technique, because of which the unskilled part of our nation, that is unskilled laborers which are there in our country, they will be unemployed. Yes or no? So who is going to take the responsibility? We thought then when these foreigners come and do business with us, the employment will increase, but actually the employment will not increase, but rather it will deteriorate. As far as labor standards are concerned, no one is concerned about the labor standards. Come on, you are aware about it, isn't it? You must have seen the people who are carrying so much of luggage on bike and traveling from one city to another city just to deliver the parcels. You know, these are the kind of mechanism which is run by these international traders. However, that's the disadvantage, which we call it as negative labor market outcomes. Next one, there will be economic exploitation. Now when we talk about economic exploitation, the underprivileged country, right? So underprivileged country will be taken as advantage from a privileged country. So developed economy will try to take the advantage of the developing economy as well as the underdeveloped economy. Next one, there will be excessive stress on exports and profit driven exhaustion of natural resources. Now students, when they enter into our market, when there is more and more trade happening, they will not be concerned about our natural resources. They will try to exploit our natural resources. Yes or no? So when they are exploiting our natural resources, it will deteriorate our health of environment, resulting into global warming. Next one, It might have an adverse effect on the development of domestic industries. Even domestic industry students will be vulnerable. Next one, risky dependence. If we are dependent on some country of the world, then it will be harmful for us. Yes or no? Next one, instead of cooperation among nations, trade may breed rivalry. Trade may breed rivalry. Now recently, students, you must be aware about the trade war which took place between United States of America and China. Now we have opened up the trade by thinking that these countries will come together. But you also know, these countries, rather than coming together, they are just drifting apart. They are fighting amongst each other. Now do you think that is beneficial for our economy? Not at all. That's why we say it may breed a rivalry. So these are the important points, students. Now in your examination, you can be asked for 2 marks. Write a note on international versus internal trade. Write a note on advantages, or what are the advantages or merits, what are the disadvantages or demerits. So similarly, students, for 2 marks, you have to write minimum for up to 5 to 6 points you can write in your examination in order to get the full 2 marks, right? It should be point wise, not paragraph wise, and per point, students, you have to write around 3 to 4 lines so that your answer looks amazing. Okay, so make your answer so presentable, so unique, fill it with these content, and definitely you will be getting maximum marks. Next, now let's talk about the theories. So first of all, we are going to discuss all these theories one by one, and then we will go on to the theoretical part, that is the marking part. Let's begin with the first one. It is mercantilist view. Now, when we talk about mercantilist view, who are they? So this theory was basically formed by merchants. Merchants were not economists, right? So this theory was very popular in Europe, especially between 1500 to 1800. That is like, 16th century to 19th century, they were, dealing with this kind of theory. Now this is a very traditional form of doing business, but however many countries have done it, so let's discuss that. Now what was the view of mercantilists? Let's talk about that. Mercantilists were of a view that either you can be an exporter or you can be an importer. You would say, sir, what comedy these people do. Today also you can be an exporter or importer. No. Earlier, either you are an exporter. Listen to the word very carefully. Either you are an exporter or you are an importer. You cannot be both. See, today when I talk about exporter and importer, a person, an institution, country can be an exporter or it can be an importer. However, earlier there were either exporter or importer. Now, when we talk about exporter, so what merchants said, that let exporter only export. So exporters will go on exporting more and more. So they go on selling goods. Okay? And importers in return go on purchasing more and more goods from them, and they give away their entire gold and silver, that is the natural resources that they had. So importer will give away entire gold and silver to exporter. By this means, what will happen? The exporter will become more and more richer, and importer will become more and more poorer. Do you agree to this? Now, do you think this is fair? Absolutely not. So if this is unfair, what do we call this? This is called as zero-sum game. Now what do you mean by zero-sum game? It means that the person who is rich, that is the exporter, will always win at the cost of importer losing. So the exporter always wins and the importer always loses. This is nothing but mercantilist view or zero-sum game. I hope, friends, you are very clear in this part. Now, have we ever experienced that, or has the world experienced this? Yes, of course. We need not go far for that, students. Even in India, Britishers came and ruled us. They were the exporting party, we were the importing party. And because of the risky dependence we had kept on them, they started exploiting us. They started ruling us. We had no other choice but to bear all the exploitation. This is what mercantilist view said. However, you also know, students, this type of model is not sustainable, right? So if it is not sustainable, that means we need a better way to work or operate. So what is a better way to work or operate? Let's talk about that. So that will call for the next theory, which is called as theory of absolute advantage. Focus on all the theories, my dear friends. Theory of absolute advantage. Now, who gave this theory? So this theory was given by Professor Adam Smith. You must have definitely heard this name because he is also referred to as father of economics. He gave this theory in the year 1776 in his book, which is called as Principles of Economics. Now, according to Professor Smith, when he wrote this theory in his book, what did he say? He said, every country cannot be good at everything. Well, I agree. But every country can be good at something. Yes. So this theory is exactly made on this statement which I shared. Now, according to Professor Adam Smith, when you go for trade, you have an opportunity what to produce, right? So he has taken one model which is nothing but 2 into 2 model. When I say 2 into 2 model, it is nothing but 2 countries, 2 commodities model. Now, what are the 2 countries and 2 commodities? Let's talk about that. So 2 countries I am taking here. First one is India. The other one is, let's suppose, Malaysia. I don't like Malaysia, so I will take Singapore instead. So Malaysia, and we have Singapore. And we will be having, let's say, 2 different types of commodities. Which are the commodities here? First one is, let's suppose, wheat. And another one would be cloth. India and Singapore. Now let's say India can produce 10 units of wheat in 1 hour of labor. So what is this? This is nothing but production per hour of labor. So Indian laborers can produce 10 units of wheat in 1 hour of labor. India can produce 2 units of cloth in 1 hour of labor. Similarly, Singapore can produce 2 units of wheat in 1 hour of labor, or they can produce 8 units of cloth in 1 hour of labor. Now, if you observe here, students, is there any trade possibility? Yes. If yes, then how? Let's talk about that. Look at India. India is having an opportunity cost of 5:1. Do you understand this 5:1 opportunity cost? That in the time period when we can produce 5 units of wheat, in the same time, students, we can produce 1 unit of cloth. Similarly, what is the Singapore's opportunity cost? It is nothing but 1:4. Now, when I say 1:4, that means in the time period where Singapore can produce 1 unit of wheat, it can produce 4 units of cloth. Now, friends, which country is having a productive efficiency in the production? So, India is having a productive efficiency in production of wheat, correct? Whereas Singapore is having a productive efficiency in production of cloth. So what is the moral of the story here? The moral of the story would be, India should divert all its productive resources in order to produce only one thing, and that is wheat. And Singapore should divert all its productive resources in production of only one thing, and that is cloth. So India sells more and more wheat to Singapore, and in return Singapore will be selling more and more cloth to India. So this is how the trade can establish between these 2 countries. We call this as theory of absolute advantage. I hope, friends, you are very clear in theory of absolute advantage. Now, there was one gentleman, David Ricardo. He was of an opinion, I agree with this theory, no problem. But I have a query. Okay. That query is, what if one country is good at producing both the commodities? I repeat, if one country is good at producing both the commodities, do you think the trade can still happen? If yes, then how? If no, then why? Let's talk about that. So please understand the next theory, students, theory number 3 in our sequence. It is called as theory of comparative advantage. Theory of comparative advantage. So now the theory of comparative advantage, friends. Again we are going to consider 2 into 2 model. First country is, let's say, India. The other country is, let's suppose, China. Two products we are taking here. First one is, let's say, rice. The other one is wine. So two countries, two product, and here I will be taking production per hour. All right. So here I will put it as production per hour. Friends, look at this very carefully. Let's say India can produce 10 units of rice in 1 hour of labor, and India can produce 10 units of wine in 1 hour of labor. So India is having a productive efficiency in producing both. India's productive efficiency is 1:1. So it hardly matters for our country that whether it should be producing rice or whether it should be producing wine. But for China, China produces, let's suppose, 2 units of rice in 1 hour of labor, and let's say 8 units of wine in 1 hour of labor. China's productive efficiency is 1:4. So now, is there any trade possible? Well, prima facie, if we look at this comparison, our first reaction would be, no sir, no need to trade. Well, let Chinese people do whatever they want, we can't trade with them. See students, if that is true, and if we flip the position, let India take China's position and China be India's position. If they are having productive efficiency and they also throw attitude like what you are saying, then do you think the world trade or the international trade will survive? No. Again, all the countries of the world will become a closed economy. That is not what we want, right? So what we need to do here? So listen to this very carefully. Here we need to take the appropriate action. How, sir? I will talk about that. So we need to find out which country will have an efficiency in exporting and importing. So now let's suppose India. When we talk about India, India is able to produce equivalent amount, be it rice or be it wine, it doesn't matter. But China is able to produce more of wine. So for the benefit of China and the world trade, what we will do, India will divert all its productive resources in production of only one thing, and that is nothing but rice, and it will export rice to China. In return, China will divert all its productive resources only in the production of wine, and it will export all its extra production, surplus production to India. So this is how the trade can establish between two countries of the world according to theory of comparative advantage. Next one, fourth one. Okay, so fourth theory is nothing but HO theory, that is Haksha and Ohlin theory of trade. Now, this theory was given by two people. One is Professor Haksha, the other one was his student, that is Ohlin. Now, there is one more name which is mentioned in the ICI text, if you have read that, Paul Samuelson. So, but that becomes a very lengthy thing, HO, like Haksha, Ohlin, Samuelson. So, they have just comprised it only to Haksha and Ohlin theory. Now, it comprises of two things, friends. First one is HO theorem, and other one is factor price equalization theorem. If you understand these two things, you can write the entire theory in your own words. Okay, just as simple as that. Now, what do you mean by HO theorem? To make you understand that, I will have to make one table here. So I am taking two countries and again two commodities. However, this time I am not considering only labor, I am considering labor as well as a capital. So here it will be first part, that is car. The other one we will be having, that is nothing but apart from car we can take wheat. Two countries we are taking here, friends. Number one, India. Number two is Germany. Now, according to you, which country should produce what commodity? Should India produce car or should India produce wheat? Now, India is a labor intensive economy or a labor surplus economy. Wheat is also a labor intensive product. So, a labor intensive product should be produced by a labor surplus economy. So, India should focus on wheat. However, Germany should focus on car. Sir, why is it so? Because car is a capital intensive product and Germany is a capital surplus economy. So, a capital surplus economy like Germany should produce more and more cars and sell it to India. India should produce more and more wheat and export it to Germany. However, HO, that is Haksha and Ohlin, were of an opinion that, sir, if this continues, then there will always be price difference between car and wheat. That is the car available in Germany and car available in India. Wheat available in Germany and wheat available in India. The price will always differ because of the factors which are different in both the countries. For example, in India, price of labor is very low, price of capital is very high. In case of Germany, price of labor is very high and price of capital is low. So they both have inefficiency in their resources. So now what to do in this case? Is there any solution? According to Haksha and Ohlin, yes. What is the solution? Let's talk about that. Now there is this country Germany and India. So according to Haksha and Ohlin, India and Germany should not only trade in goods, but they should also trade in factors. India must export more and more labor to Germany, and Germany must export more and more capital to India. So what will happen? See, price of labor in India and in Germany. Now, price of labor in India, because they are now India is exporting its labor to Germany, so there will be scarcity in Indian market. So price of labor in India, which is very low, now it will start increasing. Similarly, price of labor in Germany, which is very high, now it will start falling. At the same time, friends, let's talk about price of capital. Now, if you observe the price of capital in India, it is very high. However, if Germany supports us by exporting us more and more, what will happen? The price of capital will start falling in India, and in Germany the price of capital will start rising. There might be a point where both the products, that is price of labor and price of capital in Germany as well as in India, will become equal. So price of Germany labor, price of India's labor, price of German's capital and price of India's capital. This price of labor and price of capital both will match in both the countries. If that happens, then it will be called as factor price equalization theorem. I hope friends you are very clear in this part, that is factor price equalization theorem. So these are the two theorems. When we take these two theorems together, what we get is nothing but Haksha-Ohlin theory. Next one and fifth one, the last theory. With that our unit number 1 comes to an end. Let's have a look at it. What does this theory say? The name of the theory is New Trade Theory. This theory was developed by modern economists in the year 1970s. According to this theory, why would you go and check out what is the labor availability, what is the capital availability, whether you are capital intensive, whether you are labor, all this drama who is going to do? No one. Then what, sir? How the trade will be possible? See, modern economists are of an opinion that if you are able to conquer, if you want to do the international trade, you will try to conquer it, you will try to expand your business, right? And today the most important or the most crucial or the most common market in the world is monopolistic competition. Yes or no? So if you want to acquire this monopolistic competition through the means of trade, you have two options. What are the two options? Number one, it is nothing but economies of scale. What is number one? Economies of scale. And number two will be network effects. So economies of scale means what? Try to sell at a price which is less than your competitor's manufacturing cost. If you are able to do that, then you will be 100% successful. So economies of scale means production should be maximum, but cost of production should be minimum. If we are able to do this, that means there will be a higher level of trade which will expand in our economy. So do we have any examples here? Yes, we have Parle-G. We have MI phones, right? They have achieved what? Economies of scale. It is not creating network effects. See, what is network effect? It is nothing but demonstration effect. When people go crazy about product, if you are having that product, others also want to have that product. So do we have any example of that? Yes, example will be Apple iPhone. Or any kind of Apple products, So when we talk about Apple iPhone, when we talk about any premium or luxury products, it generally comes with network effects. And it is not compulsory that you have to be a premium product. You can also be like Instagram, you can be like Facebook, you can be like Google Maps. Once people start using that, others get attracted. Hey, how to use this? So people also fall in the same place. PUBG has also created network effects. WhatsApp has also created network effects. And look at the massive growth that they have attained. So either you have to be at economies of scale in order to conquer the entire trade which is there in the market, or you have to be in the network effects. That completes our entire unit number 1, friends. Now let's do the marking part of all the theories which we have studied one by one. First one in this sequence in our book, it is nothing but Haksha and Ohlin theory. So explain the Haksha and Ohlin theory. When we talk about Haksha and Ohlin theory, it is explaining that the countries export what can be most efficiently and plentifully produced. This model is used to evaluate trade and more specifically the equilibrium of trade between two countries. Right? We need to find out the equilibrium of trade between two countries. Emphasis is placed on what? It is placed on exportation of goods requiring factors of production that the country has in abundance and the importation of goods that a nation cannot produce as effectively. Next part, students. According to this trade, there is a special case of inter-regional trade. That is fine. Different regions have different factor endowment. That is nothing but the different kinds of factor availability. In some regions, they have abundance of labor and scarcity of capital. That is like India. Whereas in other regions, they have abundance of capital but scarcity of labor, like Japan, Germany, or US. Different goods have different production functions, that is factor of production are combined in different proportion. But what we need to do, you are already aware of. Some goods are produced by employing a relatively larger portion of labor and relatively smaller portion of capital, other goods vice versa. Therefore, difference in factor endowment is the main cause. Listen to this very carefully. Because of this factor endowment, it results into international trade as well as inter-regional trade. According to Ohlin, the immediate cause of inter-regional trade is that goods can be bought cheaper in terms of money than they can be produced. That's why people go for trade, because if you go on producing, it will be more expensive. For example, cars in India will be more expensive than the imported cars. Now, thus, it can be concluded that this theory states the labor abundant countries, that is India, have comparative cost advantage in production of goods which have labor intensive technology, and similarly for same reason capital abundant countries like Germany have comparative cost advantage in production of capital intensive products. Now friends, the concept is very simple, right? We have understood this. I hope you are very clear, and whatever we have underlined you can remember that and write the theory in your own words. Now let's focus on the next concept friends. That is nothing but explain the concept of absolute advantage. This is the absolute advantage theory which was given by Professor Adam Smith. Let's focus on this students. Adam Smith propounded that the theory of absolute cost advantage as the basis of foreign trade. It is what? It is the basis of foreign trade. You need to write the name, you need to write the theory name and the basis of foreign trade. Under this theory, an exchange of goods will take place only if each of the two countries can produce one commodity at an absolutely lower production cost as compared to other country. So one country needs to have an absolute advantage in production of one commodity as compared to other. Next, each country which has an absolute advantage over another country in the production of an item can trade such item and hence gain in the terms of international trade. Absolute advantage refers to ability of a party. Now this party can be individual, firm or a country to produce more of a good and service as compared to its competitors. Here we have taken two example students, country A, country B, product X and product Y. Right? So similarly what we had studied in our example, one more example is shared with you here. So I am very sure you are comfortable with this and you can just write any example of your choice. Let's go ahead. What are the advantages and disadvantages of this theory? First of all, advantages. Please underline students. Each country which has absolute advantage over other country in the production of an item can trade such items and it will result into gain in the terms of international trade. So for the country which is participating will have an absolute gain. One country's gain need not be other country's loss in this case. This theory recognizes the importance of division of labor. Please underline importance of division of labor, specialization, and there will be other consequent benefits also. Global output is maximized. Disadvantages, this model is a very simplistic model. Now when I say simplistic, it's good, you know. Now simplistic model means it is simple, no? But why it is a disadvantage? Because it ignores or does not recognize many practical barriers. It is so simple that it has avoided many practical barriers which can come in the purpose of trade. Labor is considered as the only factor input analysis. Now labor is the only factor which they have considered. Tell me one thing, do you think only labor produces everything? Capital is also required, but did we consider capital in absolute advantage? No. It does not consider the situation where one country has absolute disadvantage over the first country in both commodities. So we do not consider if one country is having absolute disadvantage. Does not consider situation where one country has absolute disadvantage over the other. That is not considered at all. And last one students, it emphasizes only on supply side conditions. It doesn't see whether you are having demand or no. Whatever you can supply, you start selling. How is it possible? You need to check whether there is demand or no. So these are nothing but the advantages and disadvantages of absolute advantage theory. It can be asked separately for 2 mark students, that's why I have highlighted the important points. Next one, theory of comparative advantage and modern theory comparison. There is one distinguished word, there is no marking, you need to know the entire distinguish between here. Next one is new trade theory. Now when we talk about new trade theory, what is it? It is an economic theory which was developed in the year 1970s. It came us to help understand why developed and big countries can be trade partners when they are trading in similar goods and services. These developed countries constitute more than 50% of the world trade, right? And most of them are participating in what? IT, food and automotive. Next one. These are usually the products that come in large global industries that directly impact the international economies of the world. Now, when we talk about NTT, it argues that because of substantial economies of scale and network effects, it pays to export phones to sell in other country. Now, those countries with advantages will dominate the entire market and the market takes the form of monopolistic competition. So, if you want to take participation in the monopolistic competition and lead in the market, you have 2 options. What are the 2 options? First one, either go for economies of scale or go for network effects. So when we talk about economies of scale, students, a firm which produces more of a product, its cost per unit keeps going down, and because of that you can just go on selling more and more at a cheaper price, which will give you a comparative advantage due to large scale production, and your profits are likely to be higher. But in case of network effects, the way one person's value of a goods and service is affected by the value of that of goods or services to other will influence the level of sale. The value of the product or service is enhanced. See this, the value of the product or service is enhanced as the number of individuals using it will increase. So it creates a demonstration effect, or we also call it as a bandwagon effect. The better the bandwagon effect, the higher will be the success of a particular trade. Similarly, students, consumers like choices, but they also want products and services with high utility, and the network effect offers often increased utility from these products over the others. One example which we can have is WhatsApp or software like Microsoft Windows. They have created network effects and today become billionaires. So I hope, friends, you are very clear in these theories. Whatever we have marked are very important for you to understand and remember. That's it. Now let's go ahead to the next theory, unit number 2. The next part that we are going to understand, friends, it is our unit number 2, that is instruments of trade policy. Now, what is the overview first of all of this unit? Let's understand that. When we talk about instruments of trade policy, there are 2 kinds of trade measures. Number 1, it will be import related measures. Number 2, export related measures. Now, instruments of trade policy, these instruments are either used to help the trade or to reduce the trade. So it can be basically the restrictions or the supporting factors of international trade. So import related measures can be further classified into 2 parts. What are the 2 parts? First one is tariff measures. Next one is non-tariff measures. Friends, tariff means taxes and non-tariff measures are other type of restrictions. So except taxes, if government is trying to restrict the imports by any means, then that will be called as non-tariff measures. Okay. Now in non-tariff measures, it will be further classified into 2 parts. Technical and non-technical. When we are talking about technical, so that will be product specific. Non-technical means it is feature or characteristic specific. Now, tariff measures, we are going to understand around 17 types of tariffs. Total tariff in your syllabus, 17 types. Technical, there are just 2 measures, non-technical there are 13, and export related measures there will be 4. So that's the overview of your entire unit, students. Very important unit, because there are so many things that something might definitely come in the exam. So please make sure you understand this entire unit very nicely. Let's begin. Instruments of trade policy. First of all, what do you mean by trade policy and what are the objectives of trade policy, right? So the trade policy, it encompasses all the instruments that the government may use. It is nothing but the instruments that government will use either to promote or restrict the imports and exports. So government will try to either promote the export import or restrict the export import. So in both the cases, whatever tools and regulations are used by the government, it will be called as instruments of trade policy. Trade policy also includes the approach taken by countries in trade negotiations. What are the objectives? Please underline the important points here. First one, it helps us in maintaining stable and sustainable policy environment. So stable and sustainable policy environment, if it is there, it will encourage the level of trade of goods and services. So for that we need to have a proper trade policy intact. Second, to link the procedures and incentives for exports and imports with another initiatives. Every government comes up with different kind of initiatives. All that initiatives have to be taken under one umbrella in order to follow the global trade. So different kinds of incentives and procedures should be aligned with programs such as Make in India, which is started in our country, Digital India, Skill India. And why are we focusing all those things? Because we want to promote our export and fulfill our export promotion mission. Next, it helps to provide a mechanism for regular appraisal in order to rationalize import and reduce trade imbalance. Helps us in rationalizing import. Now what do you mean by rationalizing import? If there are excessive imports, it will help us in bringing it down. Not only that, students, if there is trade imbalance, imbalance means deficit. It can be surplus, but surplus is good, it is not a disadvantage. If it is deficit, that is exports are less than imports, it is not a favorable situation, it is an unfavorable situation. So to turn this unfavorable situation into a balanced situation, what we will have? We will have trade policy. Next, trade policy allows the import of technology and equipments, which helps us to go with new product, and not only that, but adopt a new process for higher production levels. When I say higher production levels, it helps us in attaining economies of scale. Next, it also helps in the country's transition to a globally oriented, vibrant economy, so that we get the maximum benefit in reaching out to the market opportunities available in the world. Last one, students, it helps the consumer with good quality product, and that too at reasonable prices. So for all these objectives attainment, trade policies are made in all the countries of the world. Now friends, these are some of the important markings that I have given to you. This question also can be expected for 2 to 3 marks, and as you all are aware, if asked for 2 marks, then around 4 to 5 points will be sufficient. If asked for 3 marks, you will have to write all the points. Next, these are the objectives. Now let's understand the effect of tariff measures. As I told you, tariffs are nothing but taxes, isn't it? Now, when we impose taxes on our imports, what will be the effect or the impact on our trade, that we need to understand. So, let's begin. Tariff creates obstacles to trade. Do you agree to this? Higher level of tariff, that means lesser level of trade. Why, sir? Because if you are charged with higher level of tax, you will not be interested in trading, ultimately because you need to pay a very high level of tax. So at that time it will discourage the level of imports and exports. So it decreases the volume of export import and therefore of international trade. Next, tariffs will encourage the consumption and production of domestic produced import substitutes or domestic product. Well, obviously, if we are purchasing anything from abroad and if a very high level of tariff is charged on that, think about that. If a very high level of import tariff is charged, the price will substantially increase. Why would the domestic producers go and import this? Domestic producers will directly purchase Indian domestic goods which will be import substitutes. So it will encourage the production and consumption of domestic produced goods and discourage the production and consumption of foreign goods. So that is our point number 2. Producers in importing countries experience an increase in well-being. Very simple point. Introduction of tariff will increase the price of imported goods, because of which the domestic producers also have an opportunity to increase the level of price of their domestic goods, which will increase their level of well-being. Tariff creates trade distortion because it disregards the comparative advantage. Now, what do you mean by comparative advantage? India is good in one product. Some other country is very good, extremely good in some other product. But now because we levy a tariff on the imported goods, we will not be importing that commodity. We will try to manufacture that commodity by ourselves. Ultimately, what will happen? We are not able to produce it nicely and we end up making losses. What did we do? We disregarded the comparative advantage which other country was having as compared to us. We disregarded that. So actually it resulted into losses because of tariff. Tariff increases government revenue. Of course, it will be an addition to the government treasury because government gets more income from the taxes. Next part, friends. Explain the use of tariff as policy instrument. Well, why do you need a tariff first of all? What is the use? So tariff is imposed on the import or the export of the goods. In general parlance, it refers to import duties. I am very sure students you must have heard about import duties, custom duty so far. Yes or no? So this import duty, custom duty exactly is nothing but tariff. Tariff is also a policy tool to protect the domestic industries. If we impose the tariff on the imported goods, it will increase the price of imported goods. Automatically our domestic countries commodities will be available at a better price. Yes or no? So it influences or makes our life better as far as domestic industries are concerned, under which the goods compete in such a way that competitive imports are placed at a disadvantage. Competitive imports are at a disadvantage. Now these are the type of words, students, ICI gets attracted to you. Now if it is an advantage for the domestic industry, you can write competitive imports which are competing with our domestic products. They will be at disadvantage. Looks classy. Next one. A cursory examination of the tariff rates employed by different countries does seem to indicate that they reflect to a considerable extent the competitiveness of domestic industries. Okay. Now what are the different types of instruments of trade policy, which means what are the different types of tariff. Okay, so what are the tariffs? One by one we are going to understand all of them. See, if government charges a fixed rate of tariff, for example, government says pay 10% of the, if government says pay 10 rupees on each and every commodity that you have imported. Now you import it for 100 rupees, you import it for 200 rupees, or you import it for 5 rupees. You will always have to give 10 rupees as tariff. So here also it will be 10 rupees tariff, here also it will be 10 rupees tariff, and here also it will be 10 rupees tariff. So the tariff that is levied here, my friends, the tariff that you see which is levied on you here, it is fixed. The amount here, amount is fixed. They are not fixing the percentage, they are fixing the amount of tariff. Percentage might be changing. 10 rupees on 100, it is 10%. 10 rupees on 200, it is 5%. 10 rupees on 5, it is 200% of tariff. So percentage might be changing, but amount remains fixed. Such kind of tariff is called as specific tariff. So that's the meaning of specific tariff, students. What does it say? It is an import duty that assigns, very important, please underline, fixed monetary tax per physical unit of the goods imported. So when we talk about per unit charge that is levied, it will be called as specific tariff. It is calculated on the basis of unit measure such as weight, volume, etc. of the imported goods. However, on the contrary completely, it will be ad valorem tariff. Now what do you mean by ad valorem tariff? It is added on the price of the product, on the value of the product. So now when I say ad valorem, here percentage of tariff is fixed. So let's suppose the percentage of tariff is 20%. Okay, so if your amount is 100 rupees that you are importing, so you are asked to pay 20 rupees as tariff. If you purchase a product which is worth 200 rupees, you are liable to pay 40 rupees as tariff. If you purchase a product which is worth 5 rupees, you will have to pay 1 rupee as tariff, that is the 20%. So here what do you observe? Amount is changing. Amount changes, but percentage of tariff is fixed, yes or no? Such kind of tariff is called as ad valorem tariff. So ad valorem tariff is as a constant percentage of the monetary value of 1 unit of the imported goods. It is levied on the total, very important friends, value of the commodity. On what? On the value of the commodity and not on the quantity. So if you observe, specific tariff and ad valorem tariff are completely opposite. Specific tariff, percentage is not fixed, amount is fixed. Ad valorem tariff, percentage is fixed, amount is not fixed. When government imposes A plus B, that is specific duty as well as ad valorem duty. So government says, hello, you have to pay 10 rupees or 20%, whichever is higher. Okay, so let's say if your amount of import is 100 rupees, so 10 rupees will be 10, okay, 20% is 20 rupees. So we will be charging 20 rupees for that. On 200 rupees, it will be 40 rupees which will be charged. And on 5 rupees, it will be 10 rupees that will be charged. So this is how the tariff amount will be charged. Both are levied, fixed tariff and percentage tariff. I mean specific tariff and ad valorem tariff. But you need to pay whichever is higher. It will be called as which tariff, my friends? It is called as mixed tariff. So mixed tariff means either on the basis of the value of the imported goods or on the basis of the unit of measure, that is either ad valorem or specific duty, whichever generates the most income. Next is compound tariff or compound duty. What do you mean by compound tariff or compound duty? See this. Government says pay ad valorem plus specific duty, both, which means 20% as well as 10 rupees. Both have to be paid. If both are paid, then it is called as compound duty or compound tariff. Sir, what are you saying? Yes, definitely. See this. On 100 rupees, it will be 20% plus 10 rupees. So 20% is 20 plus 10. This will be 30 rupees tariff which will be charged. Are you following this? Similarly, on 200 rupees, it will be 20% plus 10 rupees. So tariff amount will be 50. Similarly, on 5 rupees, it will be 20%, that is 1 rupee plus total amount is 16 rupees after charging the taxes. However, the tax amount will be 6 rupees. I hope, friends, you are very clear in this part. Right? So this is how fourth point works, compound tariff. It is a combination of ad valorem and specific tariff. This is calculated on the basis of both the value of the imported goods, that is ad valorem as well as specific. I hope you are very clear in this. So the next one is technical or other tariff. Now friends, what do you mean by technical or other tariff? See, when you import a mobile phone, okay, so in that box you will be having mobile phone, you will be having charger, and you will be having the earphones as well. If government levies a different tariff for the handset, different tariff for the charger, and different tariff for, let's suppose, earphones. So when government charges different types of tariff on different products, then it is called as technical tariff. Okay. So technical tariff are calculated on the basis of specific contents, components or spare parts. The duties are payable by its components or related items. That's our technical tariff. Next one, friends, it is tariff rate quota. What do you mean by tariff rate quota? Up to a certain level of imports, zero tariff or a very low tariff will be charged. But once you cross that limit, if you are importing more than that, then you will be charged with a high level of tariff. That type of reserve or that type of quota will be called as tariff rate quota. So tariff rate quota combine two policies. Number one is the quantitative restrictions, which is quota. The other one is tariff. Imports entering under a specified quota portion are usually subject to a lower tariff rate or zero tariff rate. Imports are quantitative. Above the quantitative threshold of the quota face a much higher tariff. So up to a certain level, zero tariff. Above that level, you will be charged with a high level of tariff. Next one is most favored nation tariff. As the name suggests, students, most favored nation tariff are applied only on the case of WTO members. Only on whom, students? WTO members. So it encourages trade without discrimination. So it is a tariff without discrimination, where MF and tariff are what a country promises to impose on another member nation. So basically, these WTO members promise how much tariff they are going to levy on another WTO member. So that promised rate will be called as most favored nation tariff. Next one is variable tariff. Now what do you mean by variable tariff? Let's have a look at this. Now let's suppose your imports that you are doing, imports are worth 25 rupees and the domestic price is 30 rupees of the same product. So if you are manufacturing in India and selling in India, it will cost us 30 rupees. If you are importing from some other country and selling in the Indian market, it will cost us 25 rupees. Think from Indian consumers' point of view, they will give preference to only imported commodity because it is available at a cheaper price. Well, that should not be the case. So what will government do? Government will charge 5 rupees tariff on this imported goods of 25 rupees in order to match the import price with the domestic price. This kind of tariff is called as variable tariff. Simple. So variable tariff is what? It is typically a duty fixed to bring the imported price, the price of an imported commodity, up to the domestic support price. Simple. Next one is preferential tariff. What do you mean by preferential tariff? Now out of all the countries of the world, let's suppose 3 countries A, B and C make their own group, wherein their main objective is to have free trade. So between themselves, if they charge 0 tariff or a very nominal rate of tariff, this tariff which they charge on each other in the group is nothing but preferential tariff. So preferential tariff is a lower tariff that is charged from goods imported from a particular country. That country is given preferential treatment. There are various kinds of group, students, like we have European Union, we have SAARC, we have NAFTA, etc. Next, bound tariff. Students, it is very simple to understand bound tariff. It is applicable only on WTO members. And what are the tariff? What do you exactly mean by bound tariff? So it is the maximum level of tariff, which one WTO member can charge on another WTO member. It will be called as bound tariff. So bound tariff is what? It is a tariff where WTO member binds itself with a legal commitment not to raise it above a certain level. So only up to a certain level it will be charged. It will not be broken, come what may. It is called as bound tariff. Next one is escalated tariff. What do you mean by escalated tariff? There are 2 products, raw materials and finished goods. Let's say an importing firm or importing country rather charges a very high level of tariff on finished goods, on a very low tariff on raw materials. Why would any government do so? So that they import more of raw materials and less of finished goods. Such kind of tariff which is levied, it will be called as escalated tariff. Higher tariff when the goods are imported as finished goods, and lower tariff if raw materials are imported. Simple. Next one is applied tariff. Now do you remember most favored nation tariff? It is the commitment which is given by one WTO member to the WTO itself that they are going to charge this level of tariff on the another member. The promise is called as most favored nation tariff. But what they actually charge means, sir, it can be different. Yes, certainly it can be different. It can be more than what is committed, less than what is committed also. So whatever is actually charged by one WTO member on the another WTO member, it will be called as applied tariff. What's the name? Applied tariff. So applied tariff is nothing but charged on the imports of a most favored nation basis. A WTO member can have an applied tariff that differ from the bound tariff, or that the product, as long as applied level is not higher than the bound level. Bound level is the maximum amount of tariff which you can charge. You cannot breach that level. You have to charge, you are given the choice, but it has to be less than the bound level. So moral of the story, it is the tariff which is actually being charged. Next one is prohibitive tariff. What do you mean by prohibitive tariff, students? It is a very high level of tariff. So whenever there is very high level of tariff which is charged because we don't want any commodity to enter into our territory, such kind of tariff, friends, it will be called as prohibitive tariff. Next one, anti-dumping duty and countervailing measures. Well, before going there, let me tell you one more thing here. There is something called as import subsidies. Now, what do you mean by import subsidies? In this, government will pay to its importers to import more. Government will pay to its importers so that the import can be increased of some commodity which is required in the country. So in this case, it is nothing but import subsidies, also called as negative import tariff, right? Next one, friends, it is very crucial. It is called as tariff as response. Practically, we never wanted to charge a tariff. However, due to unfair trade practices which are adopted by some countries, we are left with no other option but to charge tariff on that. Such kind of tariff is called as tariff as response. Now, when we talk about tariff as response, there are two parts to it. First one is anti-dumping duty. Second one is countervailing measures. First one is anti-dumping duty, the other one is countervailing measures. What do you mean by anti-dumping duty? First of all, you need to understand what is dumping. So let's suppose you are buying a phone of Xiaomi. It is costing you in India 15,000 rupees. The same product if you buy in China, same product, okay, which is manufactured in China, it will cost you 25,000 rupees. A Chinese product in China will cost you 25,000. Same product when sold in India will cost you only 15,000. So that means the price in the international market is cheaper than the domestic market. Don't you find something fishy here? What's the problem? The problem is they are trying to dump their product in our country so that they can monopoly in the market, and then they can start exploiting our Indian economy. Well, friends, whenever any economy or any country does that, it is called as dumping. Against that dumping, what India should do? India should levy a tariff, sir. Exactly. The tariff that is levied against the dumping, it is called as anti-dumping duty. Simple, isn't it? So that's anti-dumping duty. Similarly, friends, what is countervailing measure? See this. When an exporting country is giving subsidies to whom? To its exporters to export in a particular country. Let me write down this: another country. So when the exporting government or country gives the subsidies to the exporters in order to export in another country, now this is unfair. Ideally, you should not be giving subsidies to your exporters. However, if this another country imposes tariff, let's suppose subsidies were given as 10%, and against that the tariff is also charged as 10% in order to nullify the effect of the subsidies. Such kind of tariff is called as countervailing measures. That's it. That completes our entire import related measures, but still have a look at the marking part, students. Anti-dumping duty. It is a protectionist tariff domestic government imposes on the foreign product that it believes that they are priced below the fair market value. Dumping is what? It is a process. What is dumping? It is a process where the product at a price lower than their price normally charged in this home market. The one I gave you as example of China. So such kind of economy should be charging a higher level of tariff, which is called as anti-dumping duty. Next one. What are countervailing duties, friends? Countervailing duty is on imported goods to offset the subsidies made to the producers of these goods in the exporting country. So whatever subsidies they are getting, against that subsidy we will be charging a duty which will be called as countervailing duty. If left unchecked, such subsidized imports can have severe effect on the domestic industry. So because we want to protect our domestic industry, we will never let such institutions or companies or countries to come and exploit our market. One practical example which I want to give you here. In 2016, to protect the domestic territory, India imposed 12.5% of countervailing duty on gold jewelry from ASEAN, because ASEAN countries were getting export subsidies from the ASEAN government. ASEAN is Association of Southeast Asian Nations. Do you think this is fair? No. So India levied 12.5% of countervailing duties. I hope, friends, you are very clear in this. With this, our entire tariff measures comes to an end. Now the next part we are going to understand, it is non-tariff measures. So the first one under non-tariff measure, friends, is technical measure. Now under technical measures we will be having two. First one is sanitary and phytosanitary measure. Other one is technical barriers to trade. What do you mean by sanitary or phytosanitary? Any commodity or any kind of trade, if it is harmful for human, animal or natural life, then such kind of commodity will be completely banned or restricted under sanitary and phytosanitary measure. So government can impose SPS if there is a high level of emergency which is created due to any kind of hazardous chemicals or hazardous diseases, even applicable in case of pandemic that we have recently observed. So SPS measures are applied to protect human, animal or plant life from risk arising from additives, pests, contaminants, toxins or even disease causing organisms, and to protect diversity. This includes one, it includes ban or prohibition on imported of certain goods, governing quality and hygienic requirement. It also governs the production process and associated compliance assessments. Next, for example, during avian flu, prohibition on import of poultry farms. Meat and poultry processing standards were implemented in order to reduce the pathogens. Similarly, at the time of coronavirus, many international destinations were not allowed for Indian citizens. Under what? Under sanitary and phytosanitary measure. Next one is technical barriers to trade. Now, what do you mean by technical barriers to trade? It means government will allow the import, but it will be an conditional allowance. Now, what is that conditional allowance? It can be a condition which will be levied based on the size of the product, shape of the product, design, labeling, marketing, packaging, functionality, or even performance or production method of the product. So, when all these conditions are fulfilled, only then you are allowed to import. Such kind of restriction is called as technical barriers to trade. Next, it is non-technical measures. Now friends, when we talk about non-technical measures, one by one we need to understand all the non-technical measures. Number one, it is import quota. It is not imported, it should be import quota. Now what is import quota? It is nothing but quantitative restrictions on imports. In simple words, students, quantitative restrictions on imports. Now this quota can be of two types. You can write down this part, students. First one can be absolute quota and another one can be tariff rate quota. I repeat, first one is absolute quota, the other one is tariff rate quota. What is absolute quota? Government will pre-specify the amount of input or import that you can do. Only up to that extent you can import, you cannot import more than that. That will be called as absolute quota. But let's say if government has given you a permit that up to a certain level you can import, but it will be zero tax. Above that, if you want to import, then you will have to pay tariff on that. See, if you are not allowed at all, then that is called as absolute quota. If you are allowed but with a tariff, it will be called as tariff rate quota. These are the two different measures. Both are part of import quota. Very important point. Next, price control measures. What do you mean by price control measures, my friends? Price control measure means it will try to influence the level of price through price ceiling or price floor. That means government will fix a minimum price below which you cannot import, let's say, or maximum price above which you cannot import. So when a price levied or the price related restriction is levied, it will be called as price control measures. So price control measures is levied in order to support the domestic price of certain products where the import of these goods are lower. So we will not ban it directly, but by imposing a price restriction, automatically we will stop the imports of such goods. Next one, non-automatic licensing and prohibition. Friends, animal skin of many kinds, drugs, and also tusk, shark fin are all not allowed in India to be imported. It is banned, prohibited. But for some case, if let's suppose if a person has to import this, they will have to take a license, yes or no? Will that license be automated licensing? That is, it will get automatic renewal or you can take any amount of imports, no problem? No. You will be given a restrictive permission that only up to this limit you are allowed to import. Such kind of restriction which is levied on the prohibited item even after you have license, it will be called as what? It will be called as non-automatic licensing and prohibition. So these measures are normally aimed at limiting the quantity of goods that can be imported regardless of whether they originate from single sources or from one particular supplier. Next one is financial measures. When government tries to impose different type of financial restrictions, not directly but indirectly, then it will be called as financial measures. Sir, for example, my dear friends, if let's suppose you are allowed to import, you are given the import license, but government says you will have to pay advance taxes first, only then you can import. Or government would say that RBI is not giving the foreign exchange, so you are having the permission but you don't have foreign currency to import. Tell me, will you be able to import? No. Such kind of restrictions are financial measures. So the objective of financial measure is to increase the import cost. Because of this, the import cost will increase. By regulating the access, regulating the access means charging an additional level of taxes or advance tax, and you can also change the level of cost of foreign exchange for imports. It includes measures such as advance payment requirements and foreign exchange controls, like denying the use of foreign exchange for certain type of imported goods and from certain countries. Such kind of restriction is called as financial measures. Next one, friends, it is measures affecting competition. Next one is measures affecting competition. Now, what do you mean by measures affecting competition? Well, what will government do? Government will give exclusive or special privilege only to one or few limited group of economic operators. So, for example, if you want to import palm oil in India, you cannot directly import, right? Even if you have good contacts with, let's say, Malaysia, you cannot just directly import. You will have to seek permission from STC, that is State Trading Corporation. Only they have the monopoly right of how much palm oil can be imported in the country. So one channel or one cartel is made by the government only through which you can import into our country. Such kind of restriction is called as measures affecting competition, so that everyone doesn't enter into that and make it highly competitive and ruin the imports by increasing it. So to restrict that, government will make one channel. Next one is rules of origin. What do you mean by rules of origin? Government will take the product and will check each and every component of the product where it is manufactured, and according to that manufacturing country, the rules will be levied. Sir, for example, sir, if iPhone is assembled in China, so government will check, oh, if it is assembled, then in which country it is originating. So RAM originated in Japan, camera originated in USA, glass originated in China, something else originated in Vietnam, in Malaysia, in Singapore, and then it was sourced and brought to India or to China, assembled it and then sold it to India. Now Indian government applies the rules on each and every product which is regarding that particular location where the company's products originates from. Such kind of heavy rules are called as rules of origin. So rules of origin are the criteria needed by government of imported country to determine the national source of the national source of the product, since duties and restrictions in several cases depend upon the source of import. Next one, trade related investment measures. This is very simple. What do you mean by trade related investment measures? Government is having a very simple expectation from the importers. You want to import? Go ahead and import, no problem. But when you are importing, some part of the imported commodity should be domestic. So if you are importing a commodity, import, no problem, but please have some domestic component in it. That will be called as trade related investment measures. So these measures include rules on local content requirements that mandate a specified fraction of final goods should be produced domestically. Very clear in this, friends? That is trade related investment measures. Next one is restriction on post sale services. Now what do you mean by post sale services? Delivery of the goods is post sale service. Installation is post sale service. Servicing, maintenance, guarantee and warranty, all these are nothing but post sale services. These services must be done only by Indian firm. So product can be imported, but product company cannot do all these things. That has to be done only by Indian firm. So restriction is not there on the product, restriction is there on the post sale service. Restriction on post sale services. Producers may be restricted from providing the after sale service for the exported good in the importing country. Such services may be reserved to local service companies of the importing countries. Simple. Similar to this one, friends, it is distribution restriction. Now what do you mean by distribution restrictions? Let me help you with one example. You will find imported exclusive fruits coming into our country, but not in local market. You will find that only in supermarket and shopping malls. Why? Why they are not being sold in the local market? It is not allowed. Who restricts it? Government. So government restricts the level of distribution, my friends. Government restricts what? Government restricts the distribution. That is called as distribution restrictions. So these are nothing but limitations imposed on the distribution of goods in the importing country, involving additional license and certification requirement. Basically it can be geographical restrictions. I hope you are very clear in this. The last 2 points here, friends, are safeguard measures and embargoes. Now what do you mean by safeguard measure and embargoes? Safeguard measure means temporary ban. Embargoes means complete ban or total ban. If let's say in an Indian firm or in the Indian market, if there is abundance or surplus of production which is done of a particular commodity, and the similar kind of commodity we are also importing, it will exploit our domestic market. So to safeguard our domestic market, if we impose temporary restrictions or ban on the imported commodities, it will be called as safeguard measure. However, if we impose complete ban on them, it will be called as embargoes. So these are the last 2 points, friends. I hope you are very clear in this. The last part, it is nothing but export related measures. I will explain you what are the 4 export related measures here itself. First one in export related measure is export ban. When this can be levied? If let's say a particular product in India itself there is scarcity, and if you go on selling that product into other countries of the world, government will have no other option but to restrict you from exporting that particular commodity. That is called as export ban. Second one, if government doesn't restrict but government wants you to export less, so it will try to discourage you. And how will exporters get discouraged? By charging a higher level of tax. So if export taxes are levied, that will restrict the level of exports in the market. Third one is export subsidies. and incentives. If government wants you to export more, then government will come upfront and provide you with subsidies or incentives so that you can be encouraged to supply more to other countries of the world. That is called as export subsidies and incentives. My dear friends, fourth and last point in this unit, it is voluntary export restraints. What is voluntary export restraints? It is not a government norm or it is not banned, but voluntarily, let's suppose if the country or the country's exporters decide that they will not be exporting in a particular country for whatsoever the reason may be, it is not imposed by the government but voluntarily we have decided, then that will be called as voluntary export restraint. If government imposes a ban, it is first point. If we on our own for the time being restrict the level of exports, it will be called as fourth one. So friends, with that our entire unit number 2, instruments of trade policy, comes to an end. I hope you have understood very nicely tariff, non-tariff measures, export related measures very clearly. Thank you. Now let's go ahead to the next unit, that is unit number 3, trade negotiations. Unit number 3, friends. Now what is the name of the unit? It is nothing but trade negotiations. Now 2 units we have already completed in our chapter number 4. Now the next unit, trade negotiation, what exactly does it mean and how it is divided? So you need to remember, friends, in your examination also that trade negotiations are nothing but the dealings between multiple countries of the world. So now this trade negotiations will have 3 parts. So there are 3 aspects here that you need to keep in mind. First one is regional trade agreement, that is RTA. Second one is GATT, General Agreement on Tariff and Trade. Third and last one will be WTO, that is World Trade Organization. First understand the entire overview of this unit and then I will take you towards the underlining part, that is marking the important points here. But first of all, let's revise quickly the entire unit 3. First of all, friends, what do you mean by regional trade agreement? So whenever 2 countries, let's suppose country X, country Y, think about coming into contact with each other. For what? For the purpose of trade. Now if country X and country Y want to trade with each other, so they reduce the tariff barriers or non-tariff barriers. So the barriers are controlled, are evaluated, the barriers are removed. So in that case, what will happen? These 2 countries will form an agreement, such agreement wherein we can increase the trade by reducing the barriers. It will be called as regional trade agreement. You would be surprised, friends. Today, more or less every country in the world is part of one or the another RTA. There are more than 300 regional trade agreements taking place between multiple countries of the world. And I am sure you know this. You know SAARC, you know BRICS, Brazil, Russia, India, China and South Africa. You know NAFTA, you know European Union. All these institutions, all these unions, all these campaigns which are run and which are brought together, the countries come together for the purpose of trade. That's RTA. Now, there are various RTA, students, which we call it as taxonomy of RTA. Which are they? So first one will be unilateral. Now what do you mean by unilateral RTA? It is one-sided. So let's suppose if India wants to enter into an agreement with Nepal, but this is a one-sided agreement where India will just go on buying and Nepal will be only selling. Why would India do that, sir? To support the country which is less developed than India. See, what India is doing with Nepal, that is the same thing what USA will also do with India. In order to support our economy, they will buy more products for us. So when a country enters into an agreement with another country in order to uplift them, in order to enter into an agreement where the country which is less developed will be benefiting out of the trade, such kind of agreement, it is called as unilateral trade agreement. After that, students, we can have bilateral trade agreement, Now bilateral, as the name suggests students, it is reciprocal. You are trading with me, I am also trading with you, so it will be bilateral. But mind well students, here bilateral trade agreement can be between two countries. That means one country entering into an agreement with another country. It can be between one country and a group of countries taken together. I repeat, one country and a group of countries taken together. Or it can be between one group of country and another group of country. So moral of the story, it can be country to group, or it can be group to group. So these are the various types of agreements which can be present under bilateral trade agreement. Then we have something called as preferential trade agreement. What do you mean by preferential trade agreement? Do you remember preferential tariff? Whatever you charge on me, I will also charge on you. So when same level of tariff is charged on each other, it will be called as preferential tariff. After that students, we have something called as free trade area. So free trade area means whoever is coming into the partnership of trade, they will be trading at free of cost, no charges at all. Similarly students, we will have something called as common market. What do you mean by common market students? Common market is an association of all the countries coming together, not only for freely trading the products but also the factors. So it is a market wherein the products can travel from one country to another, but also factors can travel easily from one country to another country. After that friends, we have something called as European Union, which is nothing but economic and monetary union. Economic and monetary union is many a times used as synonym to European Union. Why? Because under economic and monetary union, we are just having one example, that is of European Union. This states the countries will come together in such a manner that they do not liberate only the trade, but they will also accept one single currency for the trade. So European Union, all the 27 countries have come together for the purpose of trade, and they have adopted one currency as the global currency, and that is nothing but euros, EUR. Not only that friends, they have also made one central bank which is called as European Central Bank. So that's about RTA. I hope you are very clear in this. Next one students. Now these are all small groups, you know. What about one major global group? So in order to form the entire world trade in one domain, to globalize it, an agreement was formed which is called as GATT. GATT stands for General Agreement on Tariff and Trade. Now this agreement was made in the year 1948, where all countries will come together for the purpose of doing what? For the purpose of trade. However students, in 1960s, 1970s, its rounds like Kennedy round, Tokyo round were very successful and getting signed the multilateral agreements between multiple countries. However, in 1980s, there was one more round which was done, that is Uruguay round. Uruguay round faced many challenges, many problems, because of which the GATT couldn't survive, and finally in the year 1994, GATT was abolished as an agreement or as an institution. But we need not worry students, the world trade was not going haywire. Why? Because with the end of GATT, WTO got incorporated. So in the year 1995, WTO came into presence. However, we'll go later on WTO. First, let's understand the meaning and entire part of GATT. Well students, GATT was a very promising institution, trying to increase the level of trade across the globe by reducing the tariff barriers and by abolishing non-tariff barriers. However, they were emphasizing only on goods. The problem was they were not taking concerns about services. They were not bothered about intellectual property rights. They did not cover investment under their trade treaty. The world trade was very fast, but GATT was moving very slow. There were few agreements where there was difference of opinion, so many countries backed out from the agreement students, and all these happened in the Uruguay round itself. After that students, there was no dispute settlement mechanism. Now what do you mean by no dispute settlement mechanism? It means Whenever there was clash between different countries of the world, they would approach GATT, but GATT was not able to help them. So how do you think an economy is going to survive? It will be very difficult, isn't it? So no dispute settlement mechanism. And not only that, students, GATT ended up in huge losses because of all these rounds, or because of all these points. I would say rather, Uruguay round failed very miserably. However, GATT failed, but WTO was incorporated in the year 1995, learning from the mistakes of the GATT. How, sir? First of all, WTO said, my objective is not only to liberalize trade. Of course, I want to liberalize trade, but that is not the sole objective, friends. Apart from that, I also want to increase the level of national income in all the countries. I also want to bring more and more economic growth and development. I also want to increase the level of employment opportunity. I want to reduce the level of inequalities. I want to remove poverty from the world. Now, this was a very promising institution with such a high level objective, students, which will help all the economies to grow. So the rounds which were conducted under WTO were highly successful. And not only that, friends, they also created an organizational structure. The organizational structure was a 3-tier system. Now what do you mean by 3-tier system? Like just how you have it as top level, middle level and lower level management, on the top level management, students, we will have a system which is nothing but ministerial conference. Now ministerial conference is nothing but the head of the entire WTO. After that, we will be having General Council, and later on we will be having Goods Council, Services Council and Intellectual Property Rights Council. Now, what was this structure all about? Ministerial conference are the ones who take the decisions on behalf of WTO. So they meet once in 2 years in order to decide the policies of the WTO. They delegate all the information to General Council. General Council meets several times in a year at the head office or the headquarters of WTO, that is at Geneva, Switzerland. Goods, Services and IPR Council, students, they just take the orders from General Council and get the work done. How many times do they meet, sir? They stay there. They are part of Geneva system. So this is the 3-tier system in the economy. Not only that, students, WTO also said there are some objectives that all the countries have to follow. So what are the objectives? That also we are going to talk about. What are the principles that WTO has set? We will talk about that as well. Various types of agreements that WTO has signed. We will talk about that as well. Now, by listening to all these factors about WTO, it is quite obvious that we will think that WTO was a very successful institution, yeah? Isn't it? However, let me tell you the reality. In 2001, there was one round which was conducted, which is called as Doha round. Now, the name derives because of Doha, the place which is there in Qatar. Now, according to Doha round, students, there were many agreements which were proposed by WTO. However, most of the agreements by most of the countries were objected. So it's right now 2021. It's 20 years since this round was conducted, students, but till now there has been no outcome, which means it is a limitation, it is a disadvantage. So in WTO, you have to understand what are the disadvantages, what are the objectives, what are the achievements of WTO, what are the different types of agreements that WTO has said, and not only that, what is the management structure or the organizational structure of WTO. So though this unit, that is trade negotiation, is made up of 3 parts, RTA, GATT and WTO, but still WTO will form around 70 to 80% of this unit. And my dear friends, you have to concentrate on WTO, because every now and then we can easily expect a question from WTO in our examination. So on that note, that's the overview and the revision part of our unit number 3. Now let's have a look at the book that you are already having. So the unit that we are going to talk about here, it is nothing but trade negotiations. Now under trade negotiation, the first part, describe the structure and the principles of WTO. So what are the guiding principles and what is the structure of WTO, that we need to understand. In the question, students, they can, for 3 marks, they can ask either structure or principles. So you need not write both. This is just only in the case, an exceptional case, when both the questions are asked together. So this is how your answer should look like. So what does it say? So WTO is the only global international organization which is dealing with the rules of trade between nations. So it is the only institution which focuses on the global trade. We are having many global public goods, right? Just like WTO, we have WHO, we have IMF, we have World Bank, but they are not focusing on trade. Only this institution is entirely focused on trade amongst the world. At its heart, the WTO agreements negotiated and signed by bulk of the world's trading nations and ratified in the parliaments. The goal is to help the producers of the goods and services. See, what is the goal here? It is to help the producers of goods and services, exporters and importers, okay, to conduct their business. It is which organization, students? So it is an international organization whose primary purpose is to open trade for benefit of the all. WTO activities are supported by Secretariat located in Geneva, which is the headquarters of WTO. It has got a 3-tier system of decision making. First one is, of course, ministerial conference, as you all know. So they meet how much? They meet at least once in every 2 years. Next level will be General Council. General Council, students, is a very important institution because they meet frequently at Geneva head office several times in a year, and they are responsible for trade policy review and also act as the dispute settlement body. Last one, next level will be Goods Council, Services Council and Intellectual Property Council, that we also call it as TRIPS. It reports to the General Council. These councils are responsible for overseeing the implementation of the agreements. So it is not like you have signed and that is it. No, these councils will be taking care that you have to implement these agreements into your country. Right from its inspection, the WTO has driven by a number of fundamental principles which are the foundations of the multilateral trading system. Now, what are the major guiding principles? So let's understand the guiding principles of WTO. First one, students, it is trade without discrimination. Now what happens generally, whenever there are multiple countries in the world, discrimination is quite likely. Now what do you mean by discrimination? You will give preference to one country as compared to other. Now WTO says, see, both of you are WTO members, isn't it? So if you are giving preference to one country, the same benefit has to pass on to others also. You cannot discriminate, So if you are giving benefit to one, give that same benefit to all others. If you are giving a benefit to one, give that same benefit to all others. That is what it says. Definitely trade without discrimination. Understood this part? Yes, no, yes, yes, okay. So trade without discrimination. Under the agreements, countries cannot normally discriminate between their trading partners. You cannot discriminate. You cannot discriminate between the trading partners. If a country lowers a trade barrier for one, okay, or opens up a market for one, it has to do same for all other goods and services from all other members. Okay, so there should not be discrimination. That is what this point says. Next one, national treatment principle. Treat the entire world as your own nation. That is what national treatment principle says. Okay, according to this principle, don't give preference to Indian commodity as compared to foreign commodity. Treat foreign commodity also as Indian commodity only. So when we are talking about buying a soap, be it from Hindustan Unilever Limited or be it from Patanjali, you should not be saying, oh, Patanjali is an Indian brand, so I will prefer only Indian brand. This is what WTO says, okay, not Chirag is saying. You have to prefer Indian brand, that's reality. But WTO is saying what? WTO is saying that treat every country, every product, every investment, every national as your own nationalist. So you have to give the importance to any other country of the world, any other investment in the world, as if it is yours only. When you start doing that, students, that will be called as national treatment principle. So any country should not discriminate between its own, very important guys, its own and the foreign product, services, or even the nationals. This is what it says. Now remaining part, students, you can write it in your own words, no problem. Whatever I am underlying are the most important words that you need to remember. Third one, freer trade. Very simple, students. What do you mean by freer trade? Lowering trade barriers for opening up the market is one of the most obvious means of encouraging trade as dictated by WTO. So it simply means reduction in the duties and tariff, if not removal. If you cannot remove them, at least reduce them. I will repeat the statement again. If you cannot remove them, at least reduce them. So please reduce the duties and the tariffs that you have imposed on imports and exports. That is what it calls at freer trade. Next point, students, predictability. Now what do you mean by predictability? Friends, tell me one thing. Will you be interested in dealing with a country which is completely unpredictable, unstable? They keep on changing their policies every now and then. You invest today, but you don't know whether you are going to get the returns or no, because their policy will change. Are you interested in such a company or in such a country? The answer would be no. Then what's the solution? What's the solution? You have to be predictable. You have to be stable. Your policies should not change every now and then, or it will send a wrong message to your trading partners. It will send a wrong message to the investors. Don't send a wrong message to them. Stabilize your economy. Welcome everyone. Start trading in peace and harmony. That is what predictability says. Predictability. Foreign companies, investors and government should be confident that the trade barriers will not be raised arbitrarily. Arbitrarily means without informing. Just in haywire method it will be increased. That should not happen. You should be a stable economy where people look at you and try to invest more into your organization, into your economy. This is achieved through binding tariff. What do you mean by binding tariff, students? It is we will not be increasing tariffs more than this level. It is called as binding tariff. Discouraging the use of quota and other measures used to set the limit on quantities of imports. Establishing market opportunities or opening commitments and other measures to ensure transparency. This is what predictability says. Next one, students, there should be greater competitiveness. What do you mean by greater competitiveness? You just need to remember discouraging unfair trade practices. So whenever WTO tries to discourage the unfair trade practice and support the fair trade practices, it is nothing but greater competitiveness. Understood? Next one, tariff as legitimate measure for protection of domestic industry. This point itself is like an answer. Okay. Simple meaning I will tell you. You have imposed some non-tariff measures in order to protect your domestic industries, like embargoes, safeguard measures, price control measures, isn't it? WTO says please don't do that. Please keep only one measure, which is that tariff measure. Use only tariff as a legitimate measure to protect the domestic industries. Next one, there should be complete transparency in decision making. So it says to the economy, it says to the country, whatever decisions you are taking, friend, please make sure it is completely transparent, not against the WTO policies. Progressive liberalization, what does that mean? It means that there are many trade issues of controversial natures which are similar to labor standards, non-agricultural market access, etc., to be liberalized after the discussion. Basically, let me tell you, progressive liberalization is focusing on the Doha round. Whatever pending issues were there in Doha round, WTO is asking all the countries to come together and solve it as soon as possible so a new agreement can be established and circulated in the entire world. However, these are very sensitive topics, labor standards, international trade, agricultural. So all these are very sensitive things. So not, it is not required or it is not necessary that all the countries will be agreeing on one common term. That's why there is so much of discrepancies. Next one, special privilege has to be given to whom? To less developed countries, of course. See, there are three types of countries: developed, developing, and underdeveloped. Now, the most vulnerable one will be underdeveloped. So, WTO is asking all other countries of the world to give special preferences to these underdeveloped countries so that they can also be uplifted. Protection of what? Of health and environment, which means WTO will not encourage any kind of product which is damaging your health or environment. If India is banning drugs, WTO will not say, why are you banning drugs? Let it come. No. It will only intervene in the goods which are good for the economy. Next, a transparent, effective, and verifiable dispute settlement mechanism. What does this point mean, students? Whenever we are talking about dispute settlement, so WTO says we have to be completely transparent, effective in our policies, and we should encourage more and more peace and harmony while doing the business with other countries of the world. So if there is any dispute, we need to solve it ASAP. That completes our first part in WTO, friends. That is the system of WTO, organizational structure, as well as the principles. The next one would be the concerns and the challenges which are faced by WTO. Let's understand that. So the next part, friends, what are the challenges or the concerns of WTO? So let's understand these points one by one. Following are the major concerns in respect to the functioning of WTO. First one, the progress of multilateral negotiations is very slow. When did WTO start? 1995. What is the year right now? 2021. So after so many long years, still you are trying? And not only that, before WTO also we had GATT, right? Oh, that became rhyming. Anyway, so now even GATT was trying from 1948, and look at the position right now in 2021. You are still trying to liberalize. Don't you think by now it should have been liberalized? That's why we are writing. Progress of negotiations is very slow. Next one, complex network of regional trade agreements or regional trade agreements creates uncertainties and murkiness. Achievement in liberalization of trade, agriculture, textiles, apparels, and other sectors like international commerce has been negligible. That is very small. Doha development round has run into problems, as you all are aware. Developing countries are dissatisfied because they do not get priority. Underdeveloped countries are given the priority in WTO. Developed countries can take care of themselves. So who is left now? It is the developing countries who have to face the difficulties. Why did GATT fail in India, students? What was the reason behind GATT failure? So first one, as I told you, GATT became outdated, so it was obsolete to the fast evolving contemporary complex world trade scenario. International investments had expanded substantially. However, there was nothing that GATT could do in order to look at the investments because they were just focusing on one thing, and that is goods. Intellectual property rights and trade in services were not considered in GATT. Again, that's a disadvantage, right? An institution, whenever you are making an institution which talks about global, right, global agreement, so at that time you have to consider all the aspects of trade, not only goods. You cannot be partial, you have to be general, isn't it? So that's where I think GATT became irrelevant. World mercantilist trade increased by leaps and bounds and was beyond its scope. That means the GATT was not up to the mark as far as the world mercantilist trade was concerned. Ambiguities, that is nothing but the confusions in multilateral systems, were exploited heavily because GATT was not a treaty, students, right? It was not a contract, it was just an agreement. So many people tried to evade, or they tried to prioritize their own domestic rules as compared to the GATT rules. Efforts at liberalizing agricultural trade were not successful, and lastly, there were inadequacies in institutional structure and dispute settlement mechanism. What do you mean by this? In the world, students, there are so many different countries, and of course there will be disputes, but GATT was not efficient to resolve that disputes. That's why it failed. So these are the important points, friends. Mark it as very, very, very important. So this is our VIP answer. It is asked many times in your examination. You need to remember that. And you know what is RTA, isn't it? It is nothing but grouping of countries, not necessarily belonging to the same geographical region, which are formed with the objective of reducing trade barriers or trade between the member countries. And I have already explained you what are the different types of important RTAs. First one will be unilateral trade agreement, that is one-sided. Another one is bilateral trade agreement, which will be between two countries, through group of countries, or a bloc and a country, that is a group of country and a country. Regional preferential trade agreement, do you remember this? It is reciprocal tariff, same tariff will be levied. Then we have trading bloc. Trading bloc, students, it is nothing but when the countries come together in between the member nations, it is free of cost, the trade will be done, no tariff at all, but for outsiders they will be levying a common external barrier. Free trade area, same like trading bloc, the only difference is no common external tariff is levied. Custom union will not be following the rules of MFN and it will violate that rule. Common market, as you know, it is a market between product as well as factors, both are taken into consideration. And lastly, students, it will be economic and monetary union, and for that we are having just one example, that is European Union, where they accept only one currency in the trade amongst all the countries of the world. So these are nothing but next different types of RTAs. I hope you are very clear in this. Now we spoke about GATT problems. Let's have a look at the basic understanding of GATT. So when we talk about GATT, friends, it started in 1948, went up to 1994. These are the important points that you need to remember about GATT. Now, whenever GATT used to conduct a meeting, it was called as trade rounds. And not only that, through the GATT trade rounds in the early years contemplated tariff reduction as their core issue. What was their main issue? Tariff reduction. Later on, in Kennedy round in the mid-60s and Tokyo round in 1970s, which are considered to be the most successful rounds of the GATT, led to massive reduction in bilateral tariffs. Tariffs were reduced. Establishment of negotiation rules and procedures on dispute settlement mechanism. Dumping and licensing agreements were signed. So all these changes were made in Kennedy round and Tokyo round. After that, friends, Uruguay round started and it continued from 1986 to 1994, and it was the most consequential of all rounds, 8th round of GATT and the last round of GATT. With this, WTO was born and GATT was abolished. What did Uruguay round do? The need of a formal international organization which is more powerful and comprehensive was felt by many countries in the late 80s. See this. So countries had already disregarded GATT as the powerful and comprehensive institutions. So they said we need a more powerful institution than this. Now, members established 15 groups to work on limiting restrictions in the areas of tariff and non-tariff barriers, tropical products, natural resources, products, textiles and clothing, agriculture safeguards against sudden surges in the import subsidies, countervailing duties, etc., etc. Now, when we talk about all these things, GATT wanted to liberalize it, but the countries were not interested. So because of this discrepancy, finally GATT couldn't survive. Now, the round started at Uruguay in September 1986 and was scheduled to be completed by 1990. However, due to so many differences and due to heated controversies over agriculture, no consensus we arrived at. Next one. Finally, in December 1993, the Uruguay round, which is the 8th and the most ambitious and largest ever round of multilateral trade negotiations, in which 123 countries participated, was completed after 7 years of elaborate negotiations. And finally, many agreements were signed on April 15, 1994 and took effect from 1st of July 1995, which also marked the establishment of World Trade Organization. So this is how GATT was abolished and WTO was established thanks to Uruguay round. When WTO was established, what were the objectives? So the main objectives would be international trade liberalization. Next one, to provide a forum for negotiation, resolve trade disputes, increase the transparency, cooperate with major international economic institutions like we have World Bank, World Health Organization and so on, to help developing countries so that they can also become developed. So all these objectives are part of objectives of WTO. I hope you are very clear in this part, friends. Next one, apart from these objectives, there were other objectives also, like raising standard of living, employment opportunities, growing volume of real income as well as the demand, expanding the production of trade in goods and services. So looking at all these objectives, it sounds like it is such a successful institution. But what went wrong is exactly our next question, that is Doha round. Now Doha round, see, these are all 2 marks question which we are discussing right now. So the only important points which I am highlighting, that much if you remember. Rest everything you can write it in your own words. Doha round, which was also called as the Doha Development Agenda, 9th round since the Second World War, was officially launched at the WTO's 4th Ministerial Conference in Doha, that is in Qatar, in the year 2001. It wanted to accomplish the major modifications of the international trading system through lower trade barriers and revised trade rules. The negotiations include 20 areas of trade, which were agriculture, services, trade, market access for non-agricultural products, trade in services, trade facilitation in environment, geographical indications and certain intellectual property issues. Now, with all these things, students, the countries were not forming a singular opinion, and the most controversial one will be the Doha agenda, which was on agricultural trade. Because of agricultural trade, this trade treaty was not signed, you can say, because of which even today it remains pending. Now the question that lingers in our mind, sir, what if there is no result to this, no output to this? So what will happen? No problem. Just like how GATT was abolished, WTO was incorporated. Who knows? WTO can go and some other institution can be formed. What are the achievements of WTO, students? So let's talk about the achievements. Has helped transform international economic relation to a great extent over the past 25 years. Since 1995, the dollar value, see, this is very important, the dollar value of the world trade has increased nearly fourfold. The real volume of world trade has expanded by 2.7 times. So this is 2.7 times is nothing but the quantitative part, and the next one, that is the dollar value, is nothing but the monetary aspect. The average tariff rates have almost halved from 10.5% earlier to now 6.4%. So that's a huge achievement because countries are coming together and they are trying to reduce the level of tariff. Next one, over the past 25 years, students, there has been fastest poverty reduction in the history. Fastest poverty reduction in the history. In 1995, over 1 in the 3 people living around the world fell below the World Bank's $1.90 threshold for extreme poverty. Today, the extreme poverty rate is less than 10%. That is the lowest ever. So that's amazing achievement of WTO. So we have understood the concerns of WTO as well as the achievements of WTO. These are the important points that you need to remember. The next one is nothing but overview of WTO agreements. Now what do you mean by overview of an WTO agreement, students? There are over 60 agreements in WTO, and each agreement, students, will be more than 200 to 300 pages. Now is it possible for us to remember all these 60 agreements for our examination? The answer is no. Even ICI doesn't expect you to know all of them, but ICI says at least you need to know the name of the few, right? So what are the names? Let's talk about that. You need to remember agreement on application of sanitary and phytosanitary measures. Do you remember in unit number 2 we have studied sanitary and phytosanitary measure. So how it is to be imposed or implied, for that we have an agreement, which is this one. Second one, agreement on trade related investment measures. Then we have anti-dumping agreement, agreement on rules of origin, agreement on subsidies and countervailing measures are issued. So all these points, if you observe, students, are similar to unit number 2. So in unit number 2 we have studied the rules and regulations, the instruments. Now on that instruments we have made certain agreements. So these are the agreements on that. After that it will be agreement on safeguard, general agreement on trade in services, then agreement on trade related aspects of intellectual property rights, that is TRIPS, right? There are few more agreement, students, but we have listed down here the most important agreements that you need to remember for your examination. So that completes our unit number 3. Hopefully you have understood everything. Now let's go ahead to the next part, students, that is unit number 4, exchange rate and its economic effects. Okay friends, so let's go ahead to the next unit, which is unit number 4, exchange rate and its economic effects. First I will give you the overview of the entire unit and then we go ahead with that. So exchange rate and its economic effects. If you have studied this unit, students, then you might be knowing it's a very simple unit. First of all, we need to understand what is the meaning of exchange rate. So what is exchange rate, my friends? Whenever one currency of the world is converted into any other currency of the world, the rate at which it gets converted, it is called as exchange rate, or we also call it as conversion rate. It is also called as forex or foreign exchange. Now when we are talking about exchange rate, let's say $1 is equal to 75 rupees. So whenever it is $1 is equal to 75 rupees, that means dollar is getting converted into rupees or vice versa. So this will be called as exchange rate, the rate at which it gets converted. However, now whenever we are writing this type of exchange rate in the financial world, the currencies or the exchange rate is not represented like this. It is represented somewhat like this: USD INR 75. Now again the meaning is the same, $1 is equal to 75 rupees, but the way of presentation will be different. Friends, please do remember, here United States dollars is in the first position, isn't it? So United States dollars will be called as base currency, and INR, because it is in the second position, it will be called as counter currency. Now why it is called as base currency? Because it always remains constant, that is 1. And why INR will be called as counter currency in this case? Because it keeps on fluctuating. That's the simple logic. Now when we are talking about USD INR 75 rupees, the meaning is very simple. It is $1 is equal to 75 rupees. However, now there is a concept which we have it as direct quote and indirect quote. So what is direct quote and what is indirect quote? Let's have a look at it. Now I am taking the same example here, $1 is equal to 75 rupees. So let me write down USD INR 75. Now you and me are Indians. So now for us, our currency is in second position. So whenever the domestic currency is in second position, listen to me very carefully. Whenever the domestic currency of a particular country is in the second position, for that country it will be a direct quote. So this quotation is nothing but direct quote for India. However, if I talk about United States dollars, then it will be indirect quote for whom? It will be indirect quote for United States of America. Now listen to this very carefully. Similarly, students, if I tell you we are having INRJPY, okay, let's suppose 1.20. So that means 1 INR is equal to 1.20 JPY. Now in this case, for whom it will be direct quote and for which currency it will be indirect quote? So it is very simple. For INR it will be indirect quote and for JPY it will be direct quote. Moral of the story here would be, whenever your currency is in base position, it will be indirect quote. Whenever your currency is in counter position, it will be direct quote for you. So that's direct quote and indirect quote. I hope you are very clear in this, dosto. So now we are going to understand one more thing, friends, which is called as cross rate. Now USD INR, okay, 75 rupees, INR JPY 1.20 yen. So USD INR is 75, INR JPY is 1.20. There is a common currency between these two quotations, yes or no? Yes. The common currency or the vehicle currency here is INR. That is the common one between two quotations. So this type of rate, whenever it is given, when two rates are given and between the two rates, one rate is common, it will be called as cross rate. So this type of quotation, my friends, it is called as cross rate currency. I hope you are very clear in this. That completes our basic introduction of exchange rate. Let's get it going. Next part, which is again very important part that you need to understand, and which is nothing but forex market. Now what do you mean by forex market, students? Simple, a market where buying and selling of foreign exchange or foreign currencies take place. Let me tell you a few fun facts about foreign exchange market. Number one, world's largest market. No other market is as great as forex market as far as value of transaction is concerned. Similarly, friends, it operates for 24/7 without any holiday. Next, it is divided into two types. What are the two types? First one is called as spot market. The other one is called as future market. What's the difference between spot market and future market? If the transaction is completed today itself, that is buying as well as selling, then it will be called as spot market. But if we are entering into a contract where we are paying the money right now, but we will be getting the deliverables in the future date, that will be called as future market. Similarly, friends, going ahead, when we are talking about forex market, the world's largest traded currencies, most traded currencies in the world would be United States dollars, Great Britain pound, JPY, that is Japanese yen, and EUR, that is euro. This entire market is electronically linked market. Though it is electronically linked market, world's largest market, but we should be knowing one fun fact about it, students. It is the most efficient market in the world, because the level of accuracy is just phenomenal here. However, there can be over-the-counter transactions also. Now, when we are talking about over-the-counter, that doesn't mean there will be physical location. So I can say no physical location in case of forex market. And lastly, students, who are the participants? Participants means because of which people either the currency rate will appreciate or depreciate, who buy and sell the foreign currency in the forex market. So who are the participants? Let's talk about them one by one. First one, of course, it will be the central banks themselves. They are the one who take reserves and print their currency notes, yes or no? Second one, the people who are responsible to reach out the money to the central bank, that is nothing but commercial banks. Third one is very important institution in any country, students, and that is nothing but government. Fourth one, students, after government, we can have MNCs, that is multinational corporations. We can have investors. We can have forex dealers and agents, that is nothing but middlemen. After that, we can also have the arbitrators. Do you understand the meaning of arbitrators? The people who buy from one market and sell it into the other market because of the price differences, because they want to make profit. We can also have speculators. Speculators are invest because they want to gain the financial world. In the financial world, they want to make the gains. And then we have the hedgers who try to shift risk from one party to another party. Apart from that, we shall also have some non-profit organizations or some institutions which are just doing the charity work or something like that. So these are also nothing but the participants, and it can be anyone, students, it can be tourists, it can be students, etc., etc. So basically, whoever are buying and selling the foreign currency, they will be the participants in foreign exchange market. That completes our very important answer, which is forex market. I hope you are very clear in both the parts, students. First one was the exchange rate that we understood, and second part is nothing but the forex market. Now let's go ahead to another important aspect here. One thing which you need to remember, friends, in case of forex market, or in this unit rather, how is foreign exchange determined? So now when we say $1 is equal to 75 rupees, the question here is how? How $1 is equal to 75 rupees? Why not 1 rupee is equal to $75? Basically students, whenever we demand their products, whenever we are importing more and more, that is quite likely that we are going to demand the foreign currency. And you are quite understandable now. Here it is not at all difficult to understand that whenever we are demanding a foreign currency or anything for that matter, if we demand more, the price tends to rise. So now being an Indian, we need to understand one thing. When we are wearing Nike shoes, when we are using Apple phones, when we are traveling in the cars which are manufactured abroad, when we are using the bikes which are sold by the foreign firms, when we are using the televisions, and more than television we are using, let's suppose, Netflix, we are using Amazon Prime, while shopping we are ordering it from Amazon, we are ordering it from other foreign institutions, my friend, we are importing their services. So as and when we go on importing more and more, our currency rate will go on depreciating. Let's look at the flip side. China's economy as well as the China's currency is very strong. And why is that so? Because the people in China prefer the domestic product over the imported product. Unlike India, India is not the same, students. We have adopted this foreign culture so well that more than Indian products today, foreign products are being demanded and used in the country. Hopefully the things will change soon when we start supplying instead of purchasing from other countries of the world. Make in India program in this direction has been very successful because there are many foreign institution students who are coming in India, manufacturing the products in India and also selling it from India to other countries of the world. So whenever our exports go on increasing, our economy, our currency will become more stronger. However, for the time being, we need to understand one thing. Whenever $1 is equal to 75 or it is 80 rupees or it is 70, whatever it is, it keeps on fluctuating. The reason being what? The reason being we go on demanding and supplying, because of it this foreign exchange fluctuations take place. I hope you are very clear in this. Now, before fixing or before knowing how it is to be fixed and how demand and supply are fluctuating or influencing the the exchange rate, one thing that you need to be very sure of, that what are the exchange rate regime. So when we are talking about exchange rate regime, there are two parts in this. First one is fixed exchange rate regime. The other one is floating exchange rate regime. Now, fixed exchange rate regime is also called as hard peg, and floating exchange rate regime is also called as soft peg. So when we are talking about hard peg, what does that mean? It is compared with one currency and it will not be allowed to change or fluctuate even by a single rupee or a single unit. So let's suppose if we fix this currency rate at $1 is equal to 75 rupees, now come what may, but the government has to try to fix it at this rate. It is not allowed to move even by a single rupee. Then it will be called as hard peg or also called as fixed exchange rate system. However, in the real world, students, you are aware about it, we are not having hard peg or fixed exchange rate system. That means right now it is $1 is equal to 75 rupees, but it can depreciate, also it can appreciate. That means it can move up or down, right? So it keeps on fluctuating. That's why we call Indian currency as floating exchange rate. However, students, there are various combinations between these two. So between fixed and floating, there are various combinations. And what are that combinations? That is called as IMF classification and exchange rate regime. So in that you must have studied various types. That is nothing but exchange rate arrangement with no separate legal tender. You must have studied a topic like currency board arrangement. You have also studied a topic like crawl-like arrangement, crawling peg. Yes or no? Then we have understood managed floating exchange rate system. Then it will be fixed floating exchange rate system and free floating exchange rate system. So all these types, students, that we have understood will be part of IMF classification and exchange rate regime. Which are they? That we will understand at the time of looking at your books. Later on, students, when we are talking about exchange rate regime, let's talk about determination of exchange rate. So determination of exchange rate, what does that mean? It means that the exchange rate in the economy will be determined because of the market forces. Now when I say market forces, what does that mean? It is demand and supply who will be influencing the level of exchange rate in the country. So for example, let's suppose exchange rate is 70 rupees, 75 rupees and 80 rupees. Now what does this mean? It is the valuation of $1 is equal to 75 rupees. Now when we talk about demand, listen to this very carefully, and also when we talk about supply. So demand as well as supply, students, it will be influenced because of exchange rate, yes or no? Absolutely yes. So when will people demand more of foreign currency or more of dollars in this case? When the price is 70, 75 or 80? The correct answer is when the price is 70. So at 70, students, our demand will be 30, then it becomes 20 and finally it will become 10. However, when we talk about supply, as the exchange rate goes on depreciating, that means if it becomes 70 to 75 and 75 to 80, the supply will go on increasing. I am very sure you have understood this part in your CA foundation as well, that how demand and supply can determine the level of price. It is exactly the same. If you observe, students, demand is equal to supply at this point at the price rate of 75. So at exchange rate 75, our demand will be equal to supply. Are you very clear in this part? So that is how exchange rate is determined. Now if I want to show the same thing in diagram, then how will it look like? Let's have a look. So on y-axis, x-axis, this is the exact diagram that you need to draw in your examination also, friends. On y-axis, what is the thing that we are going to take? So it will be exchange rate. On x-axis, it will be quantity demanded and supplied. Now what would be the demand curve like? Demand curve will be downward sloping, students. We are understanding macroeconomics, so you need not write all the namings here. Namings you are exempted. You have to just plot the curve and derive the right answer. So let me take here the demand curve, friends, first of all. So demand curve is downward sloping. This will be DD, and similarly the supply curve will be upward sloping. So when we are talking about supply curve, this becomes our supply curve and this is our equilibrium quantity in the country, and of course the equilibrium exchange rate. However, when we are talking about exchange rate, it will be 75 and equilibrium quantity of demand and supply will be 20 rupees. So this is how, friends, the exchange rate is calculated in the economy. Now let's go ahead. After this, does it remain constant? Absolutely not. So there are changes in exchange rate, yes or no? Now when we are talking about changes in exchange rate, it can happen due to 4 different reasons. And what are that 4 different reasons? Number 1, demand of dollar can increase. So I would say demand increases. Second one, demand of dollar can decrease. Third one, students, supply of dollars can increase. And fourth and final one, supply of dollars can decrease. So when we are talking about demand and supply, friends, here we are talking about dollars. Again I repeat, we are talking about dollars, exactly. Now because of these changes, what happens to our exchange rate? That is what we need to understand. So let's have a look at it. I am going to quickly draw a diagram, students. It is going to be a very simple diagram. So without spending more time on this, you should be understanding the entire part. So here we are having x-axis and y-axis, friends. However, please remember, I am not going to plot everything again. It is just the first diagram where I am showing. On y-axis we will be having price, on x-axis we will be having quantity demanded and supplied. Now coming on to this part, first thing that we have is nothing but the demand curve. So let me draw the demand curve for you. It will be original demand curve, DD. Second one, it is nothing but original supply curve, that is SS. What happens in this case? So this is our equilibrium quantity and this is our equilibrium price, that is 75 rupees. However, students, now let's suppose dollar demand increases. So dollar demand increases, that means increase in demand. The demand curve will shift to the right, yes or no? So the demand curve, let's suppose, shifts to the right. So this becomes our new demand curve, that is D1, D1. Now at this new demand curve, we will be having new quantity, which is excess demand in the market, and we will be having supply equilibrium to the demand, which will determine the new price, that will be nothing but 80 rupees, let's suppose. So price has increased. Now the price has increased, what does that mean? That the rupee value has depreciated. I hope, students, you understand the meaning of appreciation and depreciation. It is very simple, just have a close look at it. $1 is equal to 75 rupees. Now this can go 80, now this can go 70 also. Whenever it becomes 80, it will be called as depreciation. Whenever it becomes 70, it will be called as appreciation. Next one friends, similarly what we are going to do in this case, again we will be having quickly demand and supply curve. So this is our demand curve, downward sloping, and similarly we have our supply curve which is upward sloping. This is our equilibrium quantity and equilibrium price, let's suppose of $1 is equal to 75 rupees. In this case friends, the demand decreases. When the demand decreases, it will shift to the left. So let it shift to the left and we will be getting the new demand, that will be this one, D1 and D1. At this new demand students, why $1 will be equal to 70 rupees. So whenever $1 becomes equal to 70 rupees due to fall in demand of dollars, that means rupee has appreciated. So in this question particularly, you are understanding that how the dollar demand can influence actually the appreciation or the depreciation of rupees. Now friends, third and fourth, so again this will be y-axis, x-axis, as you all are aware. Let's directly come on to the demand curve and the supply curve friends without wasting any time. So this will be our demand curve, that is downward sloping, and the supply curve which will be upward sloping. The equilibrium price here, it will be this one, that is 75, and equilibrium quantity is Q. Now what happens when the supply increases? The supply curve will shift to the right. So let it shift to the right friends. So the new supply curve will be this one, S1, S1. At this new supply curve, what will be our new equilibrium? Look at this very carefully. It is $1 is equal to 75 rupees. Moral of the story, when the supply has increased of dollars, the rupee will appreciate. Okay, and last one students, I think you can do it on your own here. First of all, demand curve. So this is our downward sloping demand curve. Then we will be having supply curve, so upward sloping supply curve. The equilibrium quantity and the equilibrium price, my friends, the exchange rate, which is nothing but $1 is equal to 75 rupees. Now the supply has decreased. When I say the supply has decreased, that means the supply curve will shift to the left. So when it shifts to the left, what will happen to our dollar value? So here we will be having new quantity Q1, and the supply fall will lead rupees to depreciate. So I hope friends you are very clear in this all four diagrams, right? So this is how the demand and supply will influence our exchange rate. Next one, there is one small concept students that you need to remember, and that is, see, when we are talking about exchange rate, right now let's suppose $1 is equal to 75 rupees. Now this $1 is equal to 75 can become $1 is equal to 70 rupees, or it can also become $1 is equal to 80 rupees. Yes or no? When it becomes $1 is equal to 70, remember, when it becomes $1 is equal to 70, we call this as appreciation. Okay, but wait, hold on. Now this $1 is equal to 70 can happen due to two reasons. That's the new twist that you need to remember. What are the two reasons? First one is RBI can influence it to become $1 is equal to 70 rupees, or second one can be market forces. When I say market forces, it is nothing but demand and supply. So here also RBI can influence, or it can be market forces. Friends, the question here is, when RBI makes $1 is equal to 70 rupees, or it is happening due to market forces, do we use the same terminology? The answer is no. When it happens due to market forces, we shall call it, remember please, we shall call it what? It will be called as appreciation. However, if RBI influences the exchange rate, then it will be called as what? Revaluation. So if it is an interventionary measure which is used by RBI in order to change the currency rate, it will be called as revaluation. When it happens on its own, then it will be called as appreciation. Similarly friends, $1 is equal to 80 rupees. When it is done by RBI, then it will be called as devaluation. However, when market forces is doing it, it will be called as depreciation. Now, under this theoretical part also you need to understand that what will be the changes because of appreciation and because of depreciation in the economy. And that will make our last answer also, which is nothing but impact of foreign exchange on the domestic economy. So now let's have a look at the theoretical part which is given. Please keep this textbook ready in your hand and please hold a pen or a highlighter or a pencil which will help you in underlining all the important parts here. So let's have a look at the question answer, students, which you are having in your JKSC material. First question, describe the functioning of foreign exchange market. So when this type of question has come in the examination, you have to just write 5 points for 2 marks. Okay. So foreign exchange market is what? It is a global decentralized or over the counter market for trading the currencies. The market determines the foreign exchange rate. It includes all aspects of what it includes: buying, selling and exchanging currencies at current prices or at the determinant prices or determined prices for a future date. It is the largest market in the world, as you all are aware about it. Apart from that, students, there are several institutions who are working for the betterment of the forex market. Behind the scenes, banks turn to a small number of financial firms known as the dealers. So dealers are the ones who buy and sell the foreign currency in the entire world. Next one, most foreign exchange dealers are who? They are banks. Sometimes it is also called as interbank market because banks do buy and sell amongst themselves. Traders between foreign exchange dealers can be very large, involving hundreds of millions of dollars. So the trades are of high volume transaction, students. 5 major centers are New York, London, Tokyo, Zurich, which is in Switzerland, and lastly it will be Frankfurt. Foreign exchange market specialization based on the differential interest rate between the two currencies. Now, who are the participants, students? So you need to remember the names of the participants and what do they do. First one is the central banks, who try to accept the foreign currency in order to print their own currency. After that, we also have commercial banks. And see, it's quite obvious, whenever you want to go abroad or you are coming back from abroad, while going abroad you need foreign currency, while coming back from abroad you will have to sell the foreign currency. So where do you do that? You do it in the commercial bank, right? After that, brokers, arbitrators. Who are arbitrators? They, for the price difference, they buy it from one market and sell it to the another market. Then it is speculators. Now all these points we have already discussed, okay, so I'm just brushing through the points. Multinational corporations who are into international trade as well as investments. Other participants are a very small part or insignificant part of the volume of the trade. These are nothing but the individuals. Now regardless of the physical location, given the markets are highly integrated, these are highly integrated market, students. As I told you, it is one of the most efficient markets in the world. Above phenomenon occurs because of arbitrage. Now what is arbitrage, students? It is a practice of, see, very important, practice of making riskless profits by intelligently exploiting price differences of an asset at different dealing locations. Now the next part that you need to remember here, there are two types of transactions which can happen. Either it will be spot market transaction or it will be forward or future market transaction. Next, what do you understand by appreciation and depreciation of the currency and how do they affect the real economy? Now students, you are already aware of how the appreciation and depreciation works, isn't it? So let's have a look at it. Whenever $1 was equal to 75 rupees, now if it becomes 70, it is called as appreciation, and if it is becoming 80 rupees, it will be called as depreciation. That is how it works. Let's carry on. The term currency appreciation and depreciation describe the movement of the exchange rate. Obviously, currency appreciation is an increase in the value. See this, it is an increase in the value of one currency in terms to other, and currency depreciation is a fall in the value of currency in floating exchange rate system. Now this is how the currency appreciation works whenever there is increase in supply. So if you observe here, the supply has increased, it has gone towards right. So this was our original supply, and this is what we have studied in the diagram also, friends. Here if you remember, increase in supply, right? They have just covered two parts, students, in the ICI material also, but right now I have given you 4 different parts in order to understand this very properly. Next one, what are the effects of appreciation of a currency? First one, the exports will become very expensive. How will the exports become more expensive? Listen to this, you need to apply brain here. $1 was equal to 75 rupees. Now it has become 70 rupees. That is appreciation. Yes or no? Yes. So earlier for a product you were getting $1 is equal to 75. Now if you still need 75 rupees, you will have to increase the price from $1. Now maybe you have to keep it as $1.10 in order to get the advantage or same price of what you were getting earlier. So here the price will become more, so exports will become expensive. Well, at the same time imports will become cheaper, isn't it? So whatever you were importing earlier, let's suppose you are importing a phone which was earlier worth $1,000. Now you were paying $1,000 into 75 rupees earlier, that is 75,000 rupees. For the same phone, students, today you will have to pay $1,000, that is 70 rupees per dollar. It will be 70,000 rupees. Lower export minus imports. With lower export demand and greater spending on imports, we would expect fall in, very important, fall in domestic aggregate demand, causing the lower growth. And this is quite obvious, students. Whenever our imports are greater than our exports, our GDP tends to fall, aggregate demand tends to fall. Inflation will fall. Why, sir? Because if the prices of the imported commodities are falling, that means we will be making available the same goods at a cheaper price. At a cheaper price means we will be circulating that goods in the economy with the less inflation price. Lower inflation. Now what do you mean by lower inflation? If you are importing any commodity, let's suppose crude oil, right? So if that is coming at a lower price, then transportation will be cheaper, commodities price will come down, so price will fall. Now, home currency depreciation under floating exchange rate. Look at this very carefully, students. What is happening here? When we are talking about demand, so if demand increases, so it will shift to the right. So when it shifts to the right, we will be getting our new equilibrium. That means rupee will depreciate. What are the effects of depreciation? Let's understand that one by one. First one, exports will become cheaper. Now we can export more at a lower price, which means exports relatively will become cheaper. But at the same time, friends, imports will become more expensive, because when we are importing goods and services, if earlier it was available at $1 is equal to 75, now it is available at 80, we need to shell out more money from our pocket. Increased aggregate demand. Why it will be increased aggregate demand? Because exports will be greater than imports. Next, inflation is likely to occur following a depression because imports are more expensive, which will be called as cost push inflation. Next one. Now similarly, students, again we are continuing here with depreciation of our currency on the economy effect. So this will be the same answer, students. Again we have appreciation. Now we have included this because ICI has given it 2 times, but however if you have understood that points, you need not refer to the additional points. Same answer can be presented here as well. Next, following are the ways through which an economy will lose when there is overvaluation, that is appreciation or revaluation. So when will the economy lose? See this. If appreciation sets in the recovery phase means it is going up, the result would be further fall in aggregate demand and higher level of unemployment. Please understand this. Revaluation or appreciation. $1 is equal to 70 rupees now it has become. So when the economy is going up at the time of recovery, so if it becomes $1 is equal to 70 rupees, exports will be less and imports will be more. That will result into what? Fall in the aggregate demand, and it will result into unemployment, because if we are importing more, that means domestic product will be demanded less. Similarly, with increasing export prices, the competitiveness of domestic industry is adversely affected. Our domestic industry will be adversely affected because if we import more, that will disturb our domestic producers. The increasing imports and declining exports are liable to cause larger deficit, which will destroy our balance of payment and it will take it towards the disequilibrium because of the current account deficit. What are the cross rates, students? So cross rate, as you all are aware, you just need to refer to this entire answer. I had already given you the explanation. Whenever there is one currency which is common between two quotations, the quotations will be called as cross rate. After that, we have something called as arbitrage, which is very important. It refers to the practice of making risk-less profit by intelligently exploiting the price differences of an asset at different dealing locations. So if you are getting from one country at a cheaper price and in the other country it is being sold at a higher price, you will act as an intermediary by borrowing or taking it from the low price location and selling it to the high price location. This is called as arbitrage. Now, there is a potential arbitrage in the forex market as well if exchange rates are not consistent between the countries or currencies. When the price differences occur in different market, see this. Participant purchase foreign exchange in a low price market and resale in the high price market, and this process they make profit, which is called as arbitrage. Due to the operation of the price mechanism, the price is driven up in the low price market. Now because if people go on demanding more and more at the low price location, demand will rise, the price will shoot up. So see this, due to the operation of price mechanism, the price is driven up in the low price market and pushed down in the high price market. So again, automatically all the currencies of the world will be meeting at par. This activity continue until the prices in two markets are equalized. See this, until the prices in two different markets are utilized, or until they differ only by the amount of transaction costs involved in the operations. Since forex market are efficient, any profit spread on the given currency is quickly arbitraged away. So forex market are very efficient. So this type of profit spread which is available in the arbitrage, it has been quickly taken away. So if you have ever thought about becoming an arbitrager, you will have to be very fast. The softwares that we use will be very much high end so that we move faster than the foreign exchange market, because the price keeps on changing, not every minute, not every day, it changes every second, friends. So you have to be very quick, buy it quickly from the low price location, sell it to the high price location and get the arbitrage or the profit. Now similarly, we are having explained something called as terms of trade. Terms of trade are very simple, students. If I want to explain you in very simple terms, please remember, it is nothing but exports is to imports. Exports is to imports is nothing but terms of trade. Okay. Now see this, if exports are greater than imports, that means we will be having favorable terms of trade. If exports are less than imports, we will be having unfavorable terms of trade. This much you have to remember and write this explanation, the thing will be taken care of. Next one, explain something called as real exchange rate. Now there is something called as nominal exchange rate and real exchange rate. What is nominal exchange rate? It is determined by the market forces. What is real exchange rate? It is determined by the purchasing power in a particular country. Let me help you with one small example. Now let's suppose the real exchange rate, $1 will give you, let's say, 1 liter milk in United States of America. Similarly, if you want to buy 1 liter of milk in India, it will cost you 50 rupees. So if you go by nominal exchange rate, it will say $1 is equal to 75 rupees. But if you look at the price in the domestic world as well as in the foreign country, if you compare the exchange rate with the price, the ultimate exchange rate that you get will be called as real exchange rate. So in this case, in reality, if you consider the price level, okay, so what will be the price level? See, $1 is spent on milk in United States, same milk will be getting in India at 50 rupees. So ultimately it is $1 is equal to 50 rupees. So real exchange rate is $1 is equal to 50 rupees, but nominal exchange rate will be $1 is equal to 75. Of course, I have just taken a random example of milk. We can take multiple products and then in the basket we will be taking the total price in India and in United States, and we then calculate the real exchange rate. To make it simple, students, we are having a simple formula. I will help you with that. What is the formula here? Real exchange rate is nothing but nominal exchange rate into domestic price index upon foreign price index. So whatever is the price in the domestic country and in foreign country, you have to just inject that. Whatever is the nominal exchange, multiply that, and then you will be deriving your real exchange rate. As simple as that. So that's real exchange rate, my friends. It incorporates the changes in the prices and describes how many of a good or a service in one country can be traded for one of that good or service in a foreign country. The formula you already know. Now next one is nothing but devaluation and revaluation. Do you remember what is devaluation and revaluation? Yes, we have studied that. See, devaluation is nothing but the depreciation, but which is done by RBI. Similarly, revaluation is appreciation, which is done purposely by RBI. So let's write about it. Devaluation is what? It is a deliberate, very important, students. It is a deliberate downward adjustment in the value of a country's currency in relative to the another currency or group of currency. It is a monetary policy tool. Sir, what are you saying? Monetary policy tool? Yes. If you remember in chapter number 3, we have spoken about something called as analytics of monetary policy. In analytics of monetary policy, students, do you remember we have studied about different channels? Interest rate channel, exchange rate channel, quantum channel, expectations channel, and asset price channel. So in that, the exchange rate channel is the monetary policy tool that we are using. So it is a monetary policy tool used by countries that have a fixed exchange rate or nearly fixed exchange rate regime and involves a discrete official reduction in otherwise the fixed par value of a currency. The monetary authority, see this, monetary authority formally sets a new fixed rate with respect to a foreign reference currency or currency basket. In contrast, what is depreciation? So depreciation is decrease in a currency's value but due to the market forces under floating exchange rate system. Similarly, friends, what is revaluation? So it is exactly opposite of devaluation, and the terms refers to discrete raising of the otherwise fixed par value of the nation's currency. What is appreciation? Appreciation, on the other hand, is it an increase in the currency's value relative to other currencies of the world due to the major market forces, that is demand and supply, under a floating exchange rate system. So I hope, friends, you are very clear in revaluation and devaluation. We are still left with the discussion part of the exchange rate regime in this particular unit that we are going to understand in the other questions of this particular chapter. Let's carry on, friends. Next unit, that is unit number 5, the last unit in your entire syllabus. It is called as international capital movement. Now what do we have in case of international capital movement? Please understand this. The most important part that you need to understand in international capital movement, capital doesn't necessarily mean investments. See, many a times we make this mistake that whenever the word comes capital, we always say capital movement means investments from one country to another. Not necessarily. There are different types of foreign capitals that we are going to talk about. So first one is going to be types of foreign capital. After this, students, we shall be having an understanding of FDI versus FPI. Then a very important part, students, that is reasons of FDI, benefits of FDI, and problems that are associated with FDI. Then we shall be understanding FDI in India and FDI from India. So this is the overview of this small unit, students, very basic unit, but a very high chance many questions can come from this particular unit, because this is the latest topic which is in vogue in our country also, because we are bringing more and more foreign direct investments in our country. Now, first of all, what are the different types of foreign capital? So foreign capital is a comprehensive term which takes into consideration any kind of inflow of capital into the home country or from home country to abroad. Foreign capital flow refers into an economy in different ways. Some of them are as follows. First one, students, which you need to remember, it is foreign aid or assistance. Foreign aid means it can be gift, grants, donation, charity, etc. Basically, these are unilateral receipts or unilateral payments which we have made, which we do not expect to come back into our economy. So once it is gone forever. Something like that. So that will be foreign aid or assistance. Now what are the different types of foreign aid or assistance? Let's talk about that. Number one, it can be bilateral or direct intergovernment grants. When one government is giving donation to some other government, it is called as bilateral. So when Indian government is giving money to Bangladesh government or to Afghanistan government or to any other economy of the world wherein we are not expecting that money to come back, it will be called as bilateral or direct intergovernment grants. Similarly, students, then we have multilateral aid. Now what do you mean by multilateral aid? See this. Now rich countries of the world like India, USA, UK and so on, they contribute to this institution, let's suppose World Bank, as charity or gift. Then this World Bank will be giving money to other countries of the world. So let's suppose world gives funding to whom? To poor countries of the world like Pakistan. So now this will be called as what? This will be called as multilateral aid, which is coming through international organizations like World Bank. Next one we are having tied aid, and similarly we have untied aid. Tied aid means the aid is given for a particular purpose, that money should be used only for that purpose. Untied aid comes without any terms or conditions. Foreign grants. Now what are foreign grants? It can be given by one government to another government, institution to the government. It can be also transfers by the agencies without any kind of expectation in return. So these are the four types of foreign aids or assistance. Similarly, students, we will having foreign borrowings. So first one is similar to what we have studied here. It is direct intergovernment loan, one government giving loan to another government. Similarly, we have the multilateral loan, which is nothing but loan from international institutions like World Bank, exactly same as part B of first point. Soft loans are also given. Soft loans means loans which are given at a lower interest rate. External commercial borrowing is available. What do you mean by external commercial borrowing? That is the commercial borrowing which is taken by the companies. So when one company is borrowing from other country of the world, it will be called as external commercial borrowing. And finally, students, it will be trade credit facilities. Now what do you mean by trade credit facility? Whenever exporters and importers are getting some kind of trade appreciation or depreciation, or they have to wait for the payment or the receipts, at that time, friends, it will be called as trade credit facilities. Similarly, next one will be deposits from NRIs, that is non-resident Indians. Whenever people go abroad, they will be sending money to our country, right, to their family members, to their guardians. So at that time, the money which is received by Indian, it will be part of foreign capital. Next one is investment. Investment can be of two types. First one is foreign direct investment. Other one is foreign portfolio investment. Now, what is the difference between foreign direct investment and foreign portfolio investment? Well, foreign portfolio investments are also called as FII. So don't get confused, students. It is the same. Okay. Now, FDI. If let's suppose the investment comes more than 10%, so I would write it as 10% or more in the company. So if the investors are coming and investing into the country or the company wherein they take 10% or more of your equity from the market or from your personal space, that will be called as FDI. Similarly, what do you call it as FPI? It is directly entering into the market, buying stocks, bonds, etc. for the investment purpose for short term. However, the equity owned by FPI will be less than 10%. In FDI, it will be 10% or more. Next one, define FDI and what are its features. Let's talk about FDI now. So FDI basically is an investment which is made by a company or an individual in one country in business interest of the another country, in the form of either establishing business operations or acquiring business assets in the other country. So either you can start your own organization or you can invest in the existing organization. In both the cases it will be called as FDI. After that, students, what are the types such as ownership or controlling interest in a foreign company? Now, what are the three components in which the FDI can arrive? Number one, it can be in the form of equity capital. Number two, it will be reinvested earnings. That is, whatever you have earned, now you are reinvesting the same amount into the company. And last one, it will be other direct capital in the form of intra-company loans. Now, what do you mean by intra-company loans? The parent company is giving loans to the, which one loan? Parent company is giving to the subsidiary company. Simple. So parent company is having its headquarters in some foreign country. Let's suppose the subsidiary company is operating in India, so they are getting the loan from the parent company. Foreign direct investors may be individuals who can be FDI. So it can be individuals, it can be incorporated private or public enterprises. It can be associated groups of individuals or enterprises. It can be government or government agencies, estates, trust or other organization or any other combination of the above mentioned entities. Not only that, the main form of direct investments would be opening of overseas companies. So directly you go and start your own company in the foreign country. Next one, opening an overseas company. Next one would be including the establishment of subsidiaries of branches, direct company or subsidiaries, creation of a joint venture like Hero Honda on a contract basis, or joint development of natural resource and purchase of annexation of companies in the country receiving the foreign country. So purchase or annexation of the companies in the country receiving the foreign capital. So these are nothing but various ways of introduction of foreign direct investments into our country. Now what are the features of this? One thing that you need to remember here, when we are talking about features of FDI and FPI, what we are going to do, we are going to study that together in the distinguish between. So hold on to that thought. Let us first cover the meaning of FPI, then we shall be doing the characteristics of FDI and characteristics of FPI together. What are the characteristics of foreign portfolio investment? Okay, so there is a typo here. So what is the characteristics or the meaning of foreign portfolio investors? Foreign portfolio investors are also very commonly known as foreign institutional investment. It consists or comprises of securities and other financial assets passively held by, passively is a very important word here, that is indirectly, okay, not directly. They are not buying a stake from you, they invest in the market and through market they enter into the company generally. So it is passively held by the foreign investors. It does not provide the investor with direct ownership of financial asset and relatively liquid depending upon the volatility of the market. Unlike FDI, foreign capital in general moves to investment in financial stocks, bonds and other financial instruments. So foreign capital is generally into financial stocks, bonds and other financial instruments. Basically, if you observe here, it is only into financial assets, not into physical assets. FDI, whereas, right, whenever we were talking about this, it was primarily focusing on what? Physical assets. That's a very big difference between FDI and FPI. So in general, it is done by whom? By individuals and institutions through the mechanism of capital market. These flow of capital or financial capital have their immediate effect on the balance or the exchange rate rather than on production or the income generation. FPI is not concerned, see, very important, they are not concerned with either manufacture of goods or with the provision of services. They do not have, very important again, do not have intention of exercising the voting power or controlling or managing the affairs. They are not interested in controlling, whereas FDI is definitely interested. The singular intention of a foreign portfolio investor is to earn what? Remunerative return. That is it, nothing else. They just want handsome returns and they will leave the economy and go back. Logically, portfolio capital moves to a recipient country which has revealed its potential for higher returns and profitability. So foreign institutional investors will be investing in most of the profitable or high return economies of the world. Now let's check out the characteristics of FDI and FPI. So for that I will have to come on to this distinguish between. Now when they ask you distinguish between FDI and FPI, so this is the answer that you have to write. Of course I have presented here in the T format, you need not do that. You have to write down in the paragraph format. However, please remember, if they ask you only about foreign direct investment characteristics, so you will write only this part. So this becomes our answer for characteristics of FDI and this becomes our characteristics of FPI. Isn't it simple? Yeah. So let's have a look at it. FDI is what? It involves creation of physical assets, right? Physical assets will be created under FDI. FPI creates only financial assets, my friends. No physical assets are created. Second one, who is long-term investment? FDI will be long-term, isn't it? So it has long-term interest, whereas FPI has only short-term interest. See this, only short-term interest, which is invested for short periods. Which one is easy to withdraw? FPI is easy to withdraw because it is generally into stock market. At any given point of time you can withdraw your investment and go back to your country. So it is easy to withdraw, whereas FDI would be difficult to withdraw. Which one is more speculative in nature, where there is more of trade happening? So it will be in the case of FPI. So FPI is more speculative, whereas FDI will be non-speculative. Which one includes transfer of funds for creation of assets? It will be FDI. So look at this, it is often accompanied by transfer of funds, resources, technology, strategies, know-how, etc. Here it is only funds, no technology, no marketing experience, no managerial expertise, nothing. Direct impact on the employment of labor and wages, here it will be no direct impact. And lastly students, more and more FDI, that means increase in GDP, here it only increase the capital flow, it doesn't increase the level of GDP. Now if you can just look at the FDI and FPI characteristics students, coming on to the previous part again, if you just observe here, the main features of FDI are all the same, except this last one. If you observe, providing interest in the management and control, here there is no abiding interest in the management and control, all other points are the same. I hope you are very clear in this. Let's go ahead. Now what are the reasons for FDI? Now when we are talking about reasons, just don't think about it that why our country needs more foreign investment. Also think from a company's point of view, why they need to invest into multiple countries. So it has to be both ways, okay? So now when we are talking about reasons for FDI, economic prosperity and relative abundance of capital are necessary prerequisites for export of capital to the other countries. Many economies and organizations have accumulation of huge mass of reserve capital seeking profitable use. So what they can do? They can invest in some other country. The primary aim of economic agent being maximization of their economic interest, that is nothing but making more and more high level of profits. Opportunity to generate profits available in other countries. Often this type of entities to make investment in the other countries. Now following are the main factors influencing FDI. What are they? Number one, increasing interdependence. Today friends, no country in the world is independent. Every country of the world is dependent on each other. So this interdependency between multiple countries of the world makes a healthier competition and an healthier environment for the investors to go outside their borders and invest in other countries of the world. Next one, internationalization of production and investments of transnational corporations. Next one would be desire to reap, very important, economies of large scale production, which is nothing but economies of scale. Then it will be lack of feasibility of licensing agreement with the foreign producers, or rapid rate of changes in the technological innovation, then you will have to go abroad and invest. Necessity to retain direct control of production knowledge. In order to avoid future competition, you can start investing at the early stage. Risk diversification happens because of investment into multiple countries. Shared common language, if it is shared or we are having common boundaries, that can also help us in bridging the gap between the receiver and the giver, that is nothing but the receiving end of the investors and giver end of the investors. Necessity to retain complete control, optimum utilization of all the resources. If there are lower environmental standards in host country, then it will attract more investors to come and produce in their country. And lastly, students, if there is stable political environment and if politicians or let's suppose government is more supportive towards the investors, then investors would be excited to come and invest. Now, enumerate the host country determinants of foreign direct investments, or what are the determinants leading to FDI in the host country. First one, desire to procure a promising foreign firm to avoid future competition. Risk diversification, shared common language, again all the same point, students. Lower environmental standards, stable political environment, and last one will be tax differentials. This will encourage us to get more and more investors into our country. What are the factors that discourage the inflow of the foreign investors? Host country discouraging inflow, see this, discouraging inflow of foreign investment. High rate of inflation, balance of payment deficit, poor literacy and low labor skills. Rigidity in the labor market is a big disappointment for the investors. Bureaucracy and corruption, if it is there. Unfavorable tax regime, small size of the market, political instability, absence of well defined property rights. Exchange rate volatility, now the exchange rate is highly fluctuating, then people will be stubborn about investing into this particular segment. Poor track record of investors, prevalence of non-tariff barriers and stringent regulations, lack of openness and language barriers. If all these factors are present, then it will be a big no for the investors to invest in a particular country. Now, what are the different modes of FDI? Now, FDI can come in various modes. Which are they? Let us just quickly discuss that. First one, opening a subsidiary or an associate company. For example, Unilever Limited will come to India and they have made Hindustan Unilever Limited. So that is opening a subsidiary company. Equity injection into an overseas company. So for example, SoftBank came into Indian market and they invested in Ola cabs. So this is equity injection into an overseas company. Acquiring a controlling interest in an existing foreign firm. So let's suppose Vodafone came into our country and they took over something called as Hutch. So Hutch was the company in which they have taken a controlling interest. Mergers and acquisition can be Maruti Suzuki, or acquisition can be Toyota Kirloskar. Joint venture, it is Hero Honda. Greenfield investment, where the parent company comes and starts its own operation. So for example, the latest one we are having Kia. Kia Motors has entered into India. They are manufacturing here in India and they are selling it to the Indian markets. Similarly, students, now let's discuss what are the merits of FDI. Now we will be having merits of FDI as well as demerits of FDI. So following are some of the important FDI in the host country. First one, it fosters competitions and generates a competitive environment. So there will be high level of healthy competition, as well as, students, it will create an encouraging atmosphere for the domestic sellers also. By looking at the foreign investors, even domestic producers will gear up to fight against them. Healthy competition, everyone wins in that. FDI can accelerate growth and foster the economic development. Next one, better economic policies at the national level can be made. FDI also generates direct employment. Not only direct employment, it also creates indirect employment. Do you understand the difference between direct and indirect? When Amazon entered into India, the people who are hired in the Amazon office, direct employment. Because of Amazon, if sellers hire more people who are listed on Amazon, they will be called as indirect employment. Greater possibility of promotion of ancillary units, resulting in job creations and skill development. And last one, students, increased competition will increase the flow of FDI. What are the demerits? Let's talk about that also. They will be focusing only on capital intensive method, because of which there will be unemployment in the economy. They invest only if there is incentives in the form of tax holiday. So they take the advantage. Once they start paying taxes, they might leave the company or the country and go back. Next one, balance of payment will be facing deficiency, and the currency might also end up in depreciation. Jobs that require expertise and entrepreneurship skills. Jobs that require expertise and entrepreneurship skills will be retained by them in the home country itself. They will send here only the jobs which require lower level of skills, and this is what we have experienced in outsourcing business. The way they have created the BPOs and the KPOs, the call centers in the country, it is all doing the unskilled work by the laborers in India. Foreign entities are usually accused for anti-ethical practices. They are just concerned about profit. Next one, there will be ruthless exploitation of natural resources. They will not be concerned about the natural resources. They will be only concerned about the profit. This is FDI versus FPI, students, which we have already seen. Now, what are the sectors in which the FDI is prohibited? Okay, so this is a July 2021 question, so you need to remember this. All right, very important question. Lottery business. Now it can be any type of lottery. You are not allowed to bring investment into that. Gambling and betting, chit funds, nidhi companies, transferable development rights, real estate business, or manufacturing of any kind of tobacco products or its substitutes. You are not allowed to bring that into Indian territory. Now, friends, what do you mean by fixed exchange rate and what do you mean by floating exchange rate? That we have already spoken about in unit number 4. I will give you the important points here. Fixed exchange rate or pegged exchange rate system. Under fixed exchange rate system, government and central bank, see this, very important, you have to write this in the examination. Government and central bank decide the rate and the direction of the currencies. It is not left to the market. It is only in the hands of the government and in the hands of central bank. When exchange rate is generally determined by the market force, it is called as soft peg. Determined by whom? By the market force. So when it is fixed exchange rate, it will be called as hard peg. So when central bank fixes on unchanging value, when central bank sets or fixes the value, it is called as hard peg. A fixed exchange rate avoids currency fluctuation. Obviously, there will be no currency fluctuation. This system brings discipline on the country's monetary authorities because they will have to completely report to the country where they have pegged their currency with. Fixed exchange rate system encourages greater trade and investments. Under fixed exchange rate system, countries have to maintain adequate amount of foreign exchange reserves. Now, similarly, what are the points in floating exchange rate that you need to remember? Under this system, equilibrium exchange rate of countries, currency is market determined. Market determined means demand and supply. Similarly, friends, under this system, there is no intervention of central bank or of government. Under floating exchange rate system, central bank can pursue its own independent monetary policies. In case of fixed, it was a dependency on the other country when they are making monetary policy. Here it is complete independence. Under floating exchange rate, countries are not required to maintain huge foreign exchange reserves. Not required. Later on, there is greatest disadvantage of floating exchange rate. It generates lot of uncertainty. You never know. It can appreciate, it can depreciate at any given point of time. The system has a greater policy flexibility but less stability. So it is flexible but not stable. So I hope, friends, you are very clear in floating as well as fixed exchange rate. Next one is spot and forward exchange rate. There is nothing that we need to mark here because you have to remember the entire part whenever it is asked in the examination. So I hope you are very clear in unit number 5. Now there are some extra questions that we have given, that is structure of WTO. Now this WTO structure is already discussed. We have understood this all principles also. You need to remember the head points of principle, friends. We have also understood the WTO of few concerns, right? And one more thing that you need to remember very nicely, which is nothing but IMF classification. Do you remember the IMF classification? There are different types of exchange rate regimes which are set by IMF. You need to know that very thoroughly. That completes our entire part, students. I hope you are very clear in this part. Just one small thing which I want to make an announcement. There will be three types of question, as you all must be knowing already. First one will be 2 marks question, next one will be 3 marks question, and finally it will be 5 marks question. In 2 marks question, students, how much you have to write? Please remember, generally, see, in practical question you have to solve that, and practical question you have to attempt all of them, because there is an opportunity of getting full marks. How much should we expect in practical segment, sir? So it will be around 10 to 12 marks, okay, and that will be especially from chapter number 1. There will be few questions from chapter number 3 also, that M1, M2, M3, M4, but maximum focus will be on chapter 1. In theoretical part, the maximum focus will be on chapter number 4. But of course, when I say that, it shouldn't be like that, that you will be referring only to the chapters which I am mentioning as more important. You have to give priority to all the chapters and do it very nicely. For 2 marks question, remember, if you want, you can note it down also. For 2 marks question, students, you have to write around 5 to 6 points. I will keep it as 5 points. So 5 points per point, students, you have to write 3 to 4 lines. Similarly, for 3 marks, you have to write around 6 to 7 points. Let's keep it at 7 points. If you are not able to remember 7, 6 is also fine, but go for 7 if possible. How much we have to write, sir? Per point, 3 to 4 lines. That is it. For 5 marks question, you will not be having theoretical questions. In maximum possible cases, it will be the practical question, the numerical, which makes our paper very, very, very easy. So I hope whatever we have discussed, you have understood it very nicely. Whatever highlighted points we have given to you, you will remember that in the examination. With that, God bless you all. Thank you so much. All the very best.